issues that's going to be playing, in terms of like an interoperability between like blockchains and so on. But from a domestic market consumer perspective, there was an interesting article that just came up on CoinDesk today, which was an article just reciting consumer feedback in regards to the recent Shenzhen digital RMB airdrop. And most of the feedback was, why? Because we all know, like in China, and also it's the case in Korea, where digital payment infrastructure is so well already, existing. I guess from a consumer's perspective, a lot of the feedback is like, why would I use this when I have WePay? But to Doug's point, I think ultimately it's less about the consumer, but more about the central bank really integrating itself into these existing digital payment infrastructure. I think that's going to be one of the kind of key objectives. But yeah, I think for the CBDC to really take off, there's got to be demand for it. Again, GTG side of things, I don't know how that's going to play out. But from a consumer's perspective, it's not quite there at the moment, I think. Yeah.
Thanks, and just to tag on, if I may, just tag on a couple of points there. So I think as well, when we talk about the Chinese CBDC, it's not a sort of blockchain project in the way that we think about blockchain being, permissionless. It's more of a permissioned and centrally controlled DLT structure. And when you think about the development of it and how we think about other countries potentially developing CBDCs, so China started this project back in 2014. So that's a 6-year time horizon to get to testing. Now, even if another country were to start now, how quickly could they actually kind of get adoption up to testing? And we also, when we think about China, it's a centrally controlled country. So they've been able to launch the tests within 6 years of development, but they haven't had to deal with all of the things that you might get in the US or the UK or in Europe. Concerns around privacy, concerns around how is the CBDC actually being developed, all the kind of consultations that you'd see in these other markets. And so I think that's an important thing to remember when we think about the Chinese CBDC. You can't just think of it being, China's just really good at this blockchain stuff and they're launching the CBDC and everyone else is in catch-up mode, because even if everyone else were trying to catch up, I think the hurdles that exist in other countries present problems that maybe haven't been seen in the development of the CBDC in China.
Thanks, Simon. That's excellent points. Sunena, back over to you.
Yeah, I think I'm kind of making notes, even though I've talked to all of you separately, because I think you guys are making such excellent points from your vantage, from your geographies. I think this question of why now is so central to all of crypto. And then specifically, we have to keep answering those questions when we talk about, stable coins or CBDCs or crypto. Another area that I kind of want to dig into with that umbrella perspective of why and why now is DeFi or decentralized finance. And as somebody who's kind of been a crypto nerd since 2012, even I kind of sit back and it's unfathomable to see the momentum that we're seeing in the DeFi ecosystem. I think the stat that I read that kind of catalyzed this for me was it took over 3 years or so for 1 billion of ETH to be locked for DeFi projects. And just in 2020, within a matter of 6 months, over 3 billion has been now locked into ETH, for DeFi projects. So no doubt that DeFi is in the zeitgeist, and we're seeing a mass proliferation in terms of use cases and also clearly adoption, because we're getting a lot of interesting projects flowing in. What I'd love to hear from you guys is maybe, two perspectives. One around, based on the DeFi activity that you're seeing, is it living up to the ethos of decentralized finance, which is, we want to democratize financial services and we want to create a level playing field? The projects that you're seeing, do you feel that they are venturing towards that? And second, from a regulatory perspective, I mean, listen, we're still in a space where the regulators are kind of struggling to figure out how to regulate digital assets, crypto, blockchain, and now there's this DeFi thing. What are you hearing from the regulators you work with in your geography when it comes to DeFi? And, from a personal responsibility perspective, not to get too Ayn Rand about it, as a community, what should we be doing differently in order to avoid the sins of 2017 that we saw with ICOs, right? So a couple different things, and I'll let each of you maybe talk about it from the area that's closest to you, either what type of use cases and are they really democratizing finance? And then really from a regulatory perspective, how are you and your clients thinking about it? Simon, maybe we can start with you.
Sure. So why don't I start with the regulatory piece? And Doug has just published a paper on DeFi, so he'll correct me if I say anything wrong. So I think DeFi does present this sort of a pretty big challenge to the regulators. It's certainly in a lot of the papers that have been put out from regulators, where they're kind of studying the approaches that they're going to take towards regulating digital assets generally. They have made efforts to kind of carve out decentralized projects because it sort of goes completely against the way that regulators regulate, which is to regulate intermediaries. They regulate sort of people and behaviors. With decentralization these decentralized projects, it's difficult to identify how their regulatory perimeter actually kind of fits within that project. So I think there's a whole bunch of questions that the regulators will have to be grappling with as to, what does this mean for their approach to regulation? Does it actually kind of mean that they need to, rethink how some of these, how they kind of exercise their powers or where their perimeters actually are? But maybe I should pass over to Doug, and Doug can give his views as well.
Excellent, thank you.
Thanks, Simon. I'll jump in a little bit on that. I think what we're seeing is, particularly in this region, but everywhere. If we look at MiCA, the markets in assets draft regulation in the EU. If we look around this region, what we see is most jurisdictions are pretty skeptical from the standpoint of DeFi projects. Regulation is definitely not being facilitated. You're seeing not really discussions. Like in the US, you with the Hester Pierce proposal, you've had a lot of discussions around it. In this region, not really. And Simon mentioned one paper with a couple of friends of mine. I've got another paper with a couple of other friends that will be out very soon. And in both papers, we're kind of saying the same thing, that perhaps the way forward is that we know that there is a necessity, at least at the outset, of a promoter, someone to set up the system to get it started. And if one is going to take an authorization point at that stage, maybe it makes sense to require the system that is being designed to embed supervisory and regulatory requirements, what we call embedded supervision, my friends Raphael Auer and John Frost at the BIS, or embedded regulation, my friends Dirk Zesche and Ross Buckley. And I think that the idea is, to the extent that you can automate regulatory processes in the context of the system, that goes a long way in terms of, if you're thinking about what sort of approach a regulator should take, it gives a regulator a viable approach. And it also means that from the standpoint of the actual functioning of the system, there are reasons why we have these regulatory requirements. It's not just to slow markets down or to cost people money. It's because over a couple of 100 years, we've discovered that little things like disclosure tend to make markets function better. And so the opportunity to actually embed these sorts of systems in should over time increase trust and confidence in the assets and therefore support the market going forward.
That's excellent. I think, one of the cool things about the crypto ecosystem, as you alluded to, is if you're curious by nature, there's, the learning never stops. And when you look at the spectrum that falls under crypto, on one hand, you've got something called central bank digital currency and couldn't be more centralized in its structure. And on the other end, you've got this, fertile ecosystem of DeFi, where the whole premise is are no intermediaries, that, you know, you and I are directly connected, so it couldn't be more decentralized. And I think squaring that circle from a regulatory perspective is definitely a challenge. I'm curious, John or Alan, anything you'd like to add from a DeFi perspective that you might be witnessing?
Sure. Yeah. So, you know, you ask why the DeFi recently become so popular. I think that's back to the root question. So, what value blockchain can create? So, you know, in the early stage, when the ICO, you know, so popular back to 2017, 16, you know, there are many projects actually just selling the ideas. You know, it's a very blank ideas. You know, right now, they're the mainstream, and one I cannot say it's mainstream, but you know, it's popular application is gaming, gambling. You know, those stuff is actually far away from people's life. You know, it won't create a, you know, a huge value for the economy. But for DeFi, actually, it creates an opportunity for people can, you know, lending money from it and deposit. You know, and also it actually can utilize the trading side of crypto. So that's why, you know, it's got so popular, because it creates you know, a lot of value for the market itself. Yeah, I think that's why. So that's my 2 cents.
Well said. Always be adding values, then you always be closing. Michael, over to you.
Doug, I wonder whether you might talk to us a little bit about the potential for crypto to make progress on financial inclusion. It's an area that lots of people talk about. Is there reality on the ground? Are there prospects that you find interesting and exciting that might matter for financial inclusion going forward?
Yeah, you know, I think there are a couple of sides of that. One is on the sort of monetary side, often where we're actually seeing some of the biggest adoption of Bitcoin and other sort of traditional crypto assets is in the context of countries which have the worst monetary systems. And so to the extent that you have a country whose monetary and financial system isn't working well, this does actually provide an alternative. And that alternative does actually provide a pressure to governments to drive forward. The other is from the standpoint of building infrastructure systems, the way that we can use blockchain to build a variety of infrastructures that bring down costs and support wider economic activity. I think those are really important. In some ways, however, one has to say, though, that, you know, the premise of Libra, this idea of driving down costs of remittances, there's something to that. I mean, the technology, we have the technology to build systems of better cross-border payments. And I think the reality is that if we look at, for instance, Libra, you know, it's largely been brought under control from a regulatory standpoint in developed economies, major jurisdictions. But if you think about the developing world, Libra, in the context of those major currency stablecoins, is going to be very attractive compared to their existing currencies. And so currency substitution in favor of Libra is very real. And I think it's something that, if we think about it, the possibility of using blockchain in particular to build better monetary and payment systems, which are fundamental to financial inclusion, economic development more generally, is something where the possibilities are huge.
Thanks, Doug. Well said. Back over to you, Sunena.
Yeah, you know, I really appreciate those points, Doug. I think what I struggle with is sometimes I wonder if the thesis of financial inclusion getting tagged with the crypto ecosystem is maybe oversold. I think in some cases we're doing this ecosystem disservice, where maybe we're overselling and under-delivering versus under-promising and over-delivering. And you know, and I'll open it to the rest of the panelists, and maybe that's a contrarian view and you can challenge me on it. I have yet to see real deal use cases, even let's say DeFi, which we just talked about, right? I see a lot of DeFi projects. They're very exciting. They're really pushing the envelope, which is great to transform financial services. But I struggle to see how they are creating a big tent that's including a new wave of market participants that quote unquote might have been left out by Wall Street or traditional financial services, right? I think I really keenly look for those use cases, whether it's with, stablecoins, CBDCs, DeFi, Bitcoin, you name it. And all I keep seeing is the people who already have access are just getting more and greater access, right? I know we only have a few minutes before we close, but I want to throw that out to you, and you guys tell me your perspective in your geographies. Is it different, or is it similar to what we're seeing in the U.S., where the promise of financial inclusion is still far, far away?
I'm just going to make two quick
just like we have time just for about 40 seconds each.
Okay, so quick comment there is generally yes, but some of the permission systems and some of the CBDCs are probably going to make progress.
And I just wanted to add, like here in Korea, there's a much more pragmatic approach to everything blockchain. So I think the take on inclusion is different to region. And here in Korea, the concept of inclusion is more about bringing back ownership of assets to the person and leveraging blockchain technology to do that.
Got it.
Just from my perspective, I'd say the idea of the benefits of being able to fractionalize shares and real estate and things, and put that in the hands of people who otherwise wouldn't have access to those products and services is a great promise. However, what we've seen is that in an effort to kind of protect consumers in some markets, those types of products are only available to the high net worth professional investor institutional class, which then kind of means, well, so why bother doing that for financial inclusion?
Good point.
I would add, I would say the market, the public still waiting for a killer application coming from blockchain. I think it will come in soon, but still we are waiting right now. So that's
good point. I remain cautiously optimistic. Thank you. Michael, over to you for closing.
Thanks very much. Just a fantastic panel. I really loved the conversation. I know didn't get to dive as deep on all the issues as we had hoped. The 45 minutes goes very fast, but amazing conversation and lots more to come, I'm sure, from this amazing DC Fintech Week that my good friend Chris Brummer organizes. It's just a wonderful a way to get together, to learn, to share ideas, and to keep it real. And I think Alan's points there are really just critical. Let's be sure not to jump on the hype bandwagon. Let's focus on real use cases and whether it actually helps businesses, whether it actually helps people, whether it actually helps the economy. And I think this conversation helped us do that. So with that, let me turn things over to Chris Brummer at Georgetown to take us to the next panel.
Thank you so much, Michael. Thank you, Sunea, and our entire panel. I am Chris Brummer. I'm the founder of DC's Fintech Week and the director of Georgetown's Institute of International Economic Law. That was really a fantastic conversation, and it's one that we'll be building out and developing throughout the next 4 days. Now, as we had mentioned in our announcement, we canvassed the world for some of the most interesting ideas in fintech, and we wanted to bring you or bring these ideas to you in very action-packed 5 to 10 minute segments to entertain and instruct, as the philosopher Rousseau said. And we called these flash presentations just that, to provide a flash of brilliance and insight. Now, before our first flash presentation, we should explain just a couple of things. Many of these expert opinions and insight come from different pockets of the ecosystem. And these ecosystem actors involve academics, but not always. And you will hear from a leading array of venture capitalists, bankers, and other market participants chiming in, as well as those working in the nonprofit community. Now, all of our papers that will be referenced in our flash presentations are going to be posted to the DC Fintech Week Brella event platform. So if you haven't signed up already, dcfintechweek.org, you register and you can access those papers. So please do check them out. For our first flash presentation of the conference, we start things off with crypto assets, a cost-benefit analysis of enforcement actions and securities regulation.
Hello, my name is Yulia Guseva, and I'm a professor at Rutgers Law School. This paper is about crypto asset capital markets. People and markets respond to incentives and change their behavior to maximize the payoffs of their actions. This is a generally accepted axiom in microeconomics. Governments enact and enforce regulations and change those payoffs. In doing so, government agencies channel market behavior towards what is hopefully productive and net beneficial actions. So, in this article, I examined whether the policies of one specific government agency, the Securities and Exchange Commission, in application to one particular segment of the market, crypto asset capital markets, is net beneficial to market participants and efficient. In crypto, United States federal regulators operate within the framework of pre-existing pre-crypto securities and commodity regulations without reform. The SEC in particular has emerged as the leader in enforcement. In the past 3 years, the Commission has filed more enforcement actions than major foreign jurisdictions combined. The changes in penalties and SEC actions were equally more serious. Through enforcement and step guidelines, the Commission has forced crypto asset issuers and gatekeepers, such as crypto exchanges, to comply with securities law. Is this enforcement-centric approach efficient from the perspective of firms raising capital and investors in crypto securities? Unfortunately, I conclude that it does not withstand basic cost-benefit analysis and is Calder-Hicks inefficient for 2 reasons. First, DLT has propelled information disintermediation. The technology ensures information transparency and immutability. The code is often open source and viewable publicly. Smart contracts are designed to be self-executable, and organizations are autonomous and decentralized. These realities suggest that the information supplied by an intermediary, such as a traditional issuer or investment bank, is redundant from the point of view of market participants, like investors, who have direct access to data. The second reason why market participants may not receive the expected benefits from enforcement is that the current regime incentivizes issuers to avoid public placements and instead to resort to private placements. There have been only a few successful mini-public offerings to date. The obvious reasons are regulatory cost and securities law liability. Consequently, crypto issuers quite reasonably prefer private placements. Alas, private placements are built on voluntary disclosure. What does it mean? Under this approach, digital asset investors would not receive sufficient material information because issuer incentives to disclose may be weaker than those in traditional markets. A related problem is the concept of accredited investor. Accredited investors are the main participants in public and private placements. Yet this category is broad enough to include less sophisticated parties. One of the reasons is the currently imperfect proxies measuring investor sophistication. The narrative is thus complete. The SEC regulates via enforcement and ignores the significant informational component in crypto and fintech. The issuers attempting to avoid enforcement actions comply with securities law in the most rational way by resorting to private placements. In the end, the average and the less sophisticated crypto investors are exposed to the typical information asymmetry and agency costs of private placements, aggravated by the unique risks of crypto offerings. These trends undermine the economic arguments for the currently intensive enforcement of the pre-crypto rules and make the practical outcome, Calder-Hicks, inefficient. To conclude, if the Commission has opted to regulate crypto and fintech through intensive and active enforcement of the pre-crypto regulations, it at least needs to make sure that the underlying rules are efficient and net beneficial to the market and its participants. Thank you.
Thank you, Yulia. As I had said before, my name is Chris Brummer. There were a couple of technical issues there, but I'm sure we will get them figured out. We are flexible and we are globetrotters. But I wanted to, again, thank everyone for coming and for attending. As I said before, my name is Chris Brummer, and I'm the co-founder of Washington, D.C.'s Fintech Week. And I wanted to reiterate our thanks to our many hosts who are helping to support us. Obviously, the Georgetown University Law Center, the Institute for Financial Markets, and our track sponsor, Latham & Watkins. Now, getting this kind of program up off the ground isn't easy. We are obviously broadcasting from different places, from Asia to Europe and to the United States. And it's all really with the idea of bringing to a global audience really the best in the thinking from our foremost leaders from around the world. And this session here is intended to be just an example of that with Mr. Mark Branson. Libra, years on, is still one of the hottest issues in fintech, raising questions that persist today as to how Libra and the Libra Association will be regulated. And so we have a treat for you starting off our wonderful FinTech Week. We have Mark Branson, the head of FINMA, which is the Swiss Financial Market Supervisory Authority. And he is uniquely qualified to answer the question as to how Libra, in particular the Libra Association, will be regulated, with it being based in Switzerland. Now, Mr. Branson, thank you so very much for making it to FinTech Week. I know many people are eager to learn about your perspective.
Thank you. It's a pleasure to be here.
Yeah, I guess let's maybe start off with a more sort of basic question. And maybe you can tell us a little bit about Switzerland's FinTech scene. What is it exactly about Switzerland? Because we've seen quite a few fintechs sort of migrate to Switzerland. What is it exactly about Switzerland that has attracted so many different fintech projects and investments? And what exactly is it that is making it an interesting place for crypto founders, whether or not they be large entities like Libra, but also for crypto founders and, again, smaller players?
Yeah, well, Chris, I guess the starting position is a good one because it's a country with a great tradition in finance, and it's a country that's tech savvy. So you have the pools of knowledge. It's also a country with a great research culture and great universities. So there's a lot of talent. And there's a lot of talent focused around both themes, finance and technology. So I guess this is the question about how do clusters arise, and there are some strong clusters of activity in our country around exactly this theme. I think as well what we have is a regulatory tradition which is relatively principle based. So it's not a dense network of rules and regulations, but it's something which rather sets out the rules of the road and is somewhat therefore more flexible for innovative projects. And that's the way we've tried to operate over the past years. Try and have a very open mind and a very neutral attitude to new projects, making sure that they have a fair chance to compete, that the market in the end should decide which innovative projects are going to succeed in the financial space if they comply with the same standards and rules as traditional models, but they shouldn't be discriminated by a heavy regulatory burden. And so what we've done as an agency also over the last few years is tried to keep up with the developments and make sure that we are skilled enough to interact with project leaders on an eye-to-eye basis, that we've got enough of our own finance and tech savvy to understand what a model is going to try and achieve and whether it's going to be able to comply with our standards.
Right. We're going to get into those standards in just a second in terms of some of the interesting regulatory issues that arise connected to cryptocurrencies more generally. But I think it'd be interesting to get a little bit of the backstory, particularly with Libra. How is it that Switzerland even came to host the Libra Association? When it was announced, it certainly created a lot of attention. How did that actually happen? And were you even surprised by all of the global attention it had generated?
Well, I guess without being glib, you'd have to ask the Libra Association themselves, because the way this started was actually in a way as a little bit of a fait accompli, and David Marcus and his team came to visit us, and as they did many of my colleagues around the world, and pitched, if you like, an idea that they wanted to do no less than revolutionize the world of money, which of course makes for an interesting conversation. And then they dropped into the conversation that we want to do it from here. Point being that they'd already chosen to base themselves here before we ever had our first conversation. So they'd scanned the globe for the right place to base the infrastructural part of their project, and found that some of the aspects that we've just been discussing make this an attractive center to be based. So that was the starting point. This was not something that was subject to any kind of beauty contest or competition between financial centers playing themselves off against one another, or any kind of arbitrage. And I think that's important to realize from the start. But because of the ambition level of the project, because of the backers behind the project, it was clear to us from the very first moment that this would grab an enormous amount of attention, and it would put a big call on our time, resources, and energy as well. But in a way that we've experienced as being intensive, but also also very worthwhile, because it's a project which is laying down the gauntlet to the payments industry and the cross-border payments industry in general, and making a claim that there's a much better way to serve the client. So as a catalyst, I think whatever you think about the project, there are very many different views that have been expressed over the period of time that it's been on the blocks. What you can't deny is that it's been a very welcome catalyst for looking at this corner of financial services, which has been badly served.
I was struck with your initial sort of, I guess, maybe 5 to 10 seconds of your answer, which was, yes, someone walks into your door saying, we're going to revolutionize the world of money. It has to be a very interesting way to dive sort of headfirst into what can be a somewhat technically complex area. And then you ended your answer talking about, how this is a way to think through sort of larger crypto-related issues and payments-related issues in financial services. Maybe you can go into that a little bit deeper. I mean, how have your conversations with the folks over at the Libra Association impacted the way in which you look at cryptocurrencies more generally? I mean, in the past session, there was a little bit of a number of conversations about the use cases for crypto, how effective crypto will be. I mean, certainly you've been on the front lines of thinking through and looking at those kinds of questions play themselves out in real time. What have you learned thus far? And again, how has it shaped your general impression of the industry?
Yeah, well, I think the first thing to say is that there was a lot of blockchain-based crypto asset type of activity, before we'd heard of a project called Libra. There were, and that's migrated over time, through fundraising activities like the ICO wave towards attempts to make cryptocurrencies a more attractive means of payment through stabilizing their value in some way, and therefore the word stablecoin was born, which in itself is controversial, but that's what we all call them now. But there have been stablecoins around for a while. There have been many different types of stablecoin projects that we had been working on, even before we started talking with this sort of mother of all stablecoin projects, which sort of dropped onto our doorstep. So because of its scale and potential scale and ambition, I think it does represent a wake-up call that maybe some of the other projects haven't done, because it's been more difficult to see them as something that could potentially become systemic and global, and therefore a game changer. So that's where Libra has been different for us and for many of our colleagues than a lot of the previous activity, and so it really forces us to answer some of the questions that the technology would be posing anyway. If the technology is going to succeed, if the technology is really going to deliver what it has promised to do, then these questions aren't going to go away, because whether it's Libra or another provider, if the technology is a successful one and deployable at scale on a global basis and is going to bring client benefit that it promises, then it ain't going away, and somebody else will be deploying it, even if it's not via this project. So the questions are important, and the questions are, in a way, can be quite fundamental, because they talk to the boundary between the roles of the public sector and the private sector in the world of money, and here it's quite clear that opinions vary very widely. And what we have to do as a supervisor and an interpreter of an issuer of regulation is be careful to stick to our role. And our role is actually not to solve those philosophical questions about who should have what kind of role in the world of money, but say, if this project is going to go forward, under what conditions should it be allowed to do so? And that on the basis of treating it equally with projects that have come out of the traditional world, in the sense of same risks, same rules. So it's forced us to consider those questions very deeply, and also to in a way confirm our view that when it goes around the features of a digital payment system that we require, that's to say, it's got to be safe, it's got to be crime-proof, if you like, financial crime-proof, and it's got to deliver clients a fair and transparent service. There's no reason why a blockchain-based solution can't deliver that. There are the same risks that we have in traditional payment systems, which arise in different ways in the kind of ecosystem. And we are of the view that the questions that are raised will have solutions as they do in the traditional world. I think we have to, just maybe last point, but we have to remember that the traditional world of payments and banking, is also not perfect. When we're talking about things like safety and stability, client service and crime proofing, we've not reached 100% on any of those items, nor will we ever, but we haven't reached a satisfactory level on any of those three metrics in the traditional system. So we've got to also be careful not to measure new projects against the threshold of perfection, which the traditional world has spent decades not being able to meet.
One thing that I found fascinating, again, both when you look at the evolution of Libra, I mean, certainly the the project doesn't look the same way it did when it was initially announced, and there have been some changes, both from a design standpoint of the Libra sort of coin, and then you have the different changes in governance for the Libra Association itself. But just sort of sticking to what you were talking about on the design features of the coin and payment systems and blockchain and the like. You know, when they walk in, or anyone walks in through the door, and they talk about, you know, creating a new international money, and you know, that tends to get the attention of regulators and central bankers around the world. And then you have sort of this migration in the conversation that really is focusing on sort of the payment system applications, as opposed to the concept of sort of a new international money in and of itself. And there have been lots of different reasons for this. Some, as you had mentioned, have to just deal with questions of how widely adopted it would be, and sort of systemic questions. What has this evolution in the design done to impact your perception as to how these kinds of projects should be overseen? The European Commission released recently its own sort of view of, sort of, for lack of a better word, you know, we'll call them systemically important sort of non-security based stable coins, in which are trying to make a sort of get insight into how widely adopted these different stable coins are. And it would even impact who's doing the oversight and at what level of and what degree of scrutiny would be required. What's your opinion on this in terms of how you operationalize on the ground, you know, oversight of global stable coins?
Well, I think that's obviously one of the trickiest features of any project which has you know, such an international ambition, you know, as part of its DNA, right? I mean, this is not a project which is looking to start in a jurisdiction, see whether something works, and then roll it out potentially to other jurisdictions. This is a project which is looking, you know, at the core of its business case at cross-border payments. So it's by definition international. It's by definition cross-jurisdictional. And you know, going to be operating on a cross-border basis. You know, our view right from the very beginning is that this is not a project which can be regulated or supervised out of one jurisdiction. It's going to be done on a cooperative basis between institutions like my own in various jurisdictions around the world, and that's why, you know, we've been syndicating our thoughts on the best way to look at this project and other projects like it with our colleagues around the world right from the start. And I think that's something that all of the people running such projects, including Libra, have realized and accepted and welcomed from the start, that you know, this is not something that can be designed, implemented, regulated, and supervised in one jurisdiction and then go on a sort of cross-border basis and conquer the world, if you like, from there. This has got to be something where every jurisdiction which is materially affected is comfortable with the way it looks from the start. So that's not something technical, and it's not something legal. It's something, you know, about the way we cooperate and the way we talk to each other. And luckily, the world of supervisors, regulators, central banks is very joined up. We know each other very well, and we have you know, enormous amount of forums where we can work on that, and we can work on it on a project-specific basis as well. And I think Libra as catalyst, you know, is an interesting example, because I think while the work internationally on what kind of standards you need around these stable coins has informed our approach to the Libra project, I do believe that the fact that there was a Libra project has also informed the work on the international, what kind of international standards you might want, because I think regulating innovation from an ivory tower before you have a project to talk about is going to almost certainly bring you to the wrong approach. So there is an element of iteration in this, whether you like it or not. You can't create the perfect regulation before you have a project, and vice versa. You can't regulate a single project in isolation of the way it fits in an international environment. So there is an inevitable amount of iteration, and therefore you will see an inevitable amount of potential design change as you go through projects that are this ambitious and this innovative. But I don't think that's at all new. I think most big, ambitious, technology-driven projects that we've seen have gone through multiple iterations along the way.
So you know, the question of iterations and the question of just how regulators should be really coordinating with the regulated entities, both in their own backyard and internationally, is something that certainly in the United States, we've had lots of questions about, and in other kinds of jurisdictions. You know, how do you sort of look at, you know, the formalization of that iteration? You know, is there something that Switzerland is doing to either formalize or coordinate that conversation that invariably comes when you're trying to regulate something new? And then finally, I know we're running short. You know, when you look at the product of your regulatory regime, you know, how do you see it sort of stacking up and comparing to the way in which other jurisdictions are coming out? Mm-hmm.
Yeah, no, I mean, those are very important questions, and I think to the first question, you know, how do we go about that? We have something in the regulatory supervisory world, as you know, called supervisory colleges, where, you know, which we generally use to look at existing sort of behemoths of the financial world and their risks and their preparation for crisis, etc. But we put into place a supervisory or a college of our peers to look at the Libra project before it's even started, and I think that was a unique approach for us. But that means we've syndicated information and thoughts around the project with our colleagues from around the world, you know, from around 30 jurisdictions, I think. So you know, very inclusively from the beginning, because we realized that that's the only way forward is to see how much consensus there is, and if there's not full consensus, then in the end there will be a series of decisions to be taken in individual jurisdictions. I mean, it's not our aim or mandate to, you know, make sure everybody's happy with everything about a project, but it is our mandate to understand all the different views and to make sure that the most important stakeholders around a project are comfortable with the way it's proceeding. And I think your second question about what does this mean for our regulatory framework around you know, payments, digital payments, and this type of fintech, you know, this has tested our in a way our philosophy, our belief that with a principle-based approach, you've got flexibility to deal with innovation. And I think we found that our framework, you know, stacks up and gives us the tools we need to regulate this kind of project without needing to write into statute a dedicated stablecoin regulation, for example. I mean, we have the ability and the duty to regulate important payment systems under our payment system regulation, but to put extra duties and regulation and standards in place when those payment systems have additional non-standard risks. And I think this is a project which is not just a standard payment system. So we've found that within our legal setup here, we have you know, a very nice way of dealing with this particular project, because we have this kind of modular and principle-based approach. So this time it's been tested and found that we've found that fits quite well. Whether that will always be the case, you know, we'll have to see. And as things mature and become maybe real and become categories of their own, then you can always look at how a regulation needs to adapt, because a category has begun to exist. But as I said, you know, we're trying not to fall into the trap of regulating something in detail before it exists.
Well, thank you so much for that insider's look behind the hood of what's going on in Switzerland as it comes to not only Libra, but really cryptocurrency regulation more generally. I know that the international community is really interested and remains highly interested in many of your decisions and how everything will play out. Thanks so much for taking the time to join us.
Thank you.
So we're on to now our next flash presentation. I am hearing that our AV people have gotten that link up a little bit better, and then we're going to turn to our leaders panel. But first, our flash presentation. Hit it.
Sovereign digital currencies. Hello, that's the topic of our paper. The world of money and payments is about to change soon, radically and forever. Today, cash is the only form of central bank money that most of us deal with. When your salary is paid into your bank account, when you pay your rent, when you put money on a credit card at a restaurant to pay for a meal, you're using electronic commercial bank money. Sovereign digital currencies will change all of this. It'll put central bank money in the hands of individuals. A number of countries have been working on this for at least 5 years. The leaders have been Canada, England, and China, and all of them have got as far as pilot schemes. But of late, a number of catalysts have come along to move China beyond pilots to trialling this in 4 major cities. So this sea change is right on our doorstep. The first catalyst from China's point of view was Libra, Facebook's private sector stablecoin, which was announced early-ish last year, and which provoked a remarkable response from regulators around the world. Libra learned a lesson about financial regulators. They need a lot more careful handling than the regulators Libra had clearly dealt with before. After a lot of pushback, we got Libra 2.0 this year, which is a modified version which uses a single currency stablecoin, not a multiple basket like Libra 1.0. But Libra still remains a red rag to a bull to China. It's a US-led private sector, private currency that treads into the traditional realm of sovereigns, the minting of money. So that was catalyst number 1. Catalyst number 2 was COVID, the pandemic, because the pandemic meant that all of a sudden demand on online payments increased dramatically, electronic non-face-to-face payments became the norm, and China realized that its and a number of other countries' payment systems would need to be upgraded. So given 5 years of preparation and those 2 major catalysts, China has moved to trialing its own digital currency, which it calls DCEP, Digital Currency / Electronic Payment. It's a great name because it is both currency and a payment system. It's merging the traditional difference between money and payments. So it's not only China though. Sweden, if you read the 2 most recent reports on this from the Swedish Central Bank, Sweden expects to stop issuing cash within 2 years. Already 2/3 of bank branches in Sweden do not carry cash. The reports also make clear that Sweden does not trust its poor, its rurally remote, or its elderly to be adequately serviced by commercial bank payment providers, by private sector payment providers. So the Swedish Central Bank, the implication is clear, will be moving into issuing central bank money, not on a distributed ledger for those interested in those things, but on a centralized ledger. But it's really China. And I'm very glad to see China's been doing this because for a number of years, I've been saying China will be the first country in the world to issue a sovereign digital currency. The reason I've been saying it is that a sovereign digital currency gives the government 2 really major things. It gives them information about what their citizens are doing, and it gives them much more control over what their citizens are doing. It could potentially block payments. And information and control are 2 things that the Chinese government loves to have about its citizens. So the issue is not whether China will move to this. The issue is whether China will release it for use offshore, whether DCEP will, obviously it'll begin domestically, but at some point, will it be used in international trade? Good minds differ. I'm on the side that it will, because for a long time, China has been building its own parallel international financial architecture, parallel to the architecture established by the US in the wake of World War II. And DCEP fits this perfectly. It gives China the opportunity to reclaim some of the exorbitant privilege. Barry Eichengreen used the phrase exorbitant privilege for a book that explains all the advantages the US gets out of minting the global reserve currency. China wants some of those advantages. A sovereign digital currency will enable it to seize some of those advantages. And if China's currency moves offshore, other countries will have to retaliate. They'll have to respond with their own digital currencies, because otherwise it will work so well with dematerialized trade. It will be so efficient. People will start to use digital renminbi because it simply is cheaper and faster and works better in a blockchain digital environment. And then the information on those trade transactions will end up in Shanghai, not in New York or Toronto. So China's the game changer. This change is coming. Read our paper for all of the details. Thank you very much.
Well, many issues have been certainly identified in our last flash presentation and also in our conversation with Mr. Branson. The Libra project, of course, spurred considerable attention and some controversy from regulators thinking about how they could lift their regulatory game and start innovating themselves. And ever since the announcement, central banks have increasingly espoused an interest in promoting or exploring their own central bank projects. And today, central bank digital currencies, or CBDCs, are perhaps the hottest issue in international markets and international monetary relations. And so I am absolutely delighted on this leaders panel to have some of the people really at the forefront of that conversation around the world. Most of you probably know everyone on the screen right now. I'll just quickly identify them. Benoit Cœuré, who is the head of the BIS Innovation Hub. We have John Cunliffe, the Deputy Governor of the Bank of England, Cecilia Skingsley, the first Deputy Governor of the Riksbank, and Chris Giancarlo, the co-founder of the Digital Dollar Foundation and former chairman of the CFTC. Thank you, all of you, for joining us. And to really talk through, again, these issues that are on the front lines of papers around the world. Benoit, I guess I'll start with you. How do you view the current global state of play as to CBDC development? You are really at the intersection of conversations around the world from your perch at the Bank for International Settlements. How far along are we when it comes to reaching this panacea of the global CBDC?
So, good morning from Basel, and thank you, Chris, for having us here. The FinTech Week is a really fantastic conference, so congratulations for putting it together. Well, I guess it's fair to say that CBDC is not in a way not a new issue. I mean, if you want to take a lot of steps back, it's only another step in the central bank technological journey, which has led us from papyrus to paper, and then from paper to plastic, etc. And central banks have been embracing innovation from the start, and it's only a new step they're taking. And it's also fair to say that some central banks have blazed the trail, and that was mentioned in the presentation a few minutes ago. And certainly the Riksbank is part of them, and People's Bank of China also is part of them. And they've been in many ways leading the way. And what we're seeing today is still a turning point, I would say, in terms of central banks' approaches to CBDC. And I would really describe 2020 as the moment where central banks have moved from research to action. There has been a lot of academic research on CBDC, a lot of conceptual discussion, and now it's time to move to experiments and building proofs of concepts and testing the building blocks of CBDC. The next step would be to decide on a CBDC, which in many ways has to be a political decision for each and every central bank to take. after consultation, after consulting the public, after consulting parliaments, governments, etc. But we are at the exactly at the step before that, which is going into the real life and testing the different building blocks. We've at the BIS we ran a survey earlier this year, and we found that out of all central banks in the world, 80% were studying CBDC, 80%, which is up from last year. 40% are running proofs of concepts or prototypes, and 10% are doing pilot experiments, just like the PBOC is currently doing in Shenzhen. So it tells you a lot that we are really moving to now to action. And maybe one last point worth noticing is that there is a lot of willingness to do it together. That is, there won't be one single CBDC. All CBDCs will be different because financial structures are different, preferences towards cash are different, central bank mandates are different. But there is a lot of willingness and an appetite to at least to investigate together and to identify which kind of requirements or common features and common principles are good for the system, as a system, for the international monetary system to work smoothly. And that's really the essence of the report, which was published a couple of weeks ago by 7 central banks at the BIS. It's about laying the foundations and making sure that whatever we do will not add to fragmentation in the system.
Well, Governor Skingsley, you were just referenced, and a lot of the work you were doing. What are you seeing in terms of the development of designing proofs of concept? And more specifically, what does that process look like from the inside? And what are you seeing as some of the primary barriers, both from an administrative standpoint, but also from a technical standpoint?
Well, thank you, and good morning to you all from Stockholm. So yeah, we started launching this research project about 4 years ago. I gave a speech about it. And back then, there weren't many of us interested in this issue. And our starting point was the rapid dissension of usage of cash in the Swedish society. So we thought it was prudent from the central bank to bring up a discussion with ourselves, but also with the central banking community and society as a whole. How do we actually want these things to be organized? And money is not only about technology, it's also about policy, and it's about legislation. So it's a very intricate subject, and it really sort of strikes to the core of what a state is really about and what it offers to its citizens. And as technology now flips and people adapt to new changes, we on the public side has to come along in this development and offer, as Benoit pointed out, continue our historic role and continue to offer our services in a way that is adapted to what people are using in terms of technology in our time in history. So you said ask barriers. I would have to say that I don't see technological barriers in this area, but I do see technological challenges. And the challenge is not so much technology in itself, but it's more about we have to choose what sort of policy objectives do we want to focus on? What is the problem we want to solve? And depending on what that is and the purposes we want to serve, then you choose the technology after that. And the proof of concept we are working with is not mainly a technology issue we're talking about. It's more about the features and the services that we want this e-krona to have. And you can make many different choices here and choose many different models. And that's what we're doing at the moment.
And just so that I understand there, when those technology choices come along, it's usually through is it usually through some kind of technology provider or questions as to what you want to build out in-house?
So the way we have designed the pilot project currently is that we are doing this in cooperation with the company Accenture. because we think we'd be able to kind of jump a couple of steps forward if we get some of this knowledge from the outside rather than from the inside. But there are a number of things that you can only knowledges that you can only keep within the central bank. If you think about 300 years ago, when paper technology created basically notes, you had to be very quiet about the specific features in order to make them safe. And it's a similar way things develop now, that you can use sort of external or outside competence, but some things you have to keep to yourself. And I think one of the intricate issues in this is what sort of model you want to have, because different models can serve different needs. So if we want, for example, a CBDC that strengthens innovation and competition in the private sector, we should probably go for a more decentralized model. But we, on the other hand, wants to focus the CBDC more on serving resilience, that like it works more like a backstop when all other system fails. A central bank digital currency should still be standing. Then you have to go for a more centralized model where the dependence on private intermediaries are less of a circumstance. So there are many interesting choices to handle going forward.
That's really interesting. Mr. Cunliffe, I mean, do you see sort of when you look at the basic models and design choices, is that more or less the kind of, for lack of a better word, risk reward trade-off that you're looking at, sort of the innovation versus resilience, and then tying that to, the degree of centralization? Or is there another perspective that you're taking when you're looking at a potential CBDC, and what are the kinds of models that are interesting you?
Well, first, I just emphasize the point that Cecilia made. It's important to look at this from what problem you're trying to solve and what problems you're trying to avoid. I think for us, the Bank of England put out a consultation document in February. The problem we're trying to solve is the fact that physical cash is no longer convenient. It's becoming increasingly inconvenient for people to use in their everyday lives, and the COVID crisis has accelerated that. And on the other hand, it's becoming increasingly less acceptable to merchants for some of the same reasons, even merchants that are able to take physical cash. And if that's the problem you're trying to solve, then I think that leads you to a general purpose retail CBDC. It also leads you to decisions like, do you want a model that interacts freely with other forms of money? We have a number of different forms of money that operate in our economies at the moment. That's one of the ways you get competition. It's one of the ways you get innovation. So if you want a general purpose CBDC that operates alongside other forms of money and that encourages competition and innovation, it leads you down the route of a central bank providing infrastructure, but on the other hand, allowing the private sector to use that infrastructure to innovate and ensuring that all of the private sector operate on the same basis. In our consultation document, we put out a particular model. We did that not because we've chosen a particular model. Indeed, we haven't made a decision yet whether we want to implement a CBDC. And as has been said, that's not just a choice for technocrats. That's a choice for society and for the political side as well. But we put out a model because we thought this can appear a theoretical subject to people, or blue sky thinking. And when you put something out there, then you get a much stronger response when people look at it and can see what it could do. And I think very important for us in that model was the concept of ensuring interoperability, innovation, competition, but on the other hand, also ensuring that people did continue to have access to basically state money in the form of a central bank currency. You then face a number of trade-offs. I mean, people watching, if they haven't already read it, there's an interesting report from a group of 7 central banks and the Bank for International Settlements that we put out last week. Benoit, Cecilia, and I were some of those involved in it, which then set out some of the trade-offs that you face when you try and deliver the objectives that you have. There's the trade-off between usability and convenience and security. There's the trade-off between privacy and law enforcement. There are a number of trade-offs, and then you have to make those choices in the technology. But the key thing is, before one dives into do you want a ledger or do you want a token? And I think, Chris, you're putting forward a digitalized dollar that's a token. Our consultation document had a ledger-based system. But before you dive into all of that, the key point is to establish what are you actually trying to achieve, and crucially, what are you actually trying to avoid as well in terms of the risks.
You know, what I've been struck by thus far is that the origins for many of the conversations, certainly on the other side of the pond, are driven by this question about cash and the disappearance of cash. But Chris Giancarlo, you and I speak very often and very frequently about these things, and you're certainly the leading voice really about many of the issues of a digital dollar, or the prospects thereof in the United States. How do you see the drivers of that conversation here in terms of how they compare elsewhere, from the work that you're doing over at the Digital Dollar Foundation and elsewhere? And how does that inform what you consider to be some of the models and choices facing folks a little bit in my neck of the woods here in Washington?
Thanks, Chris. And it's great to be with Benoit and with John and Cecilia. We follow their work very, very closely, and the thoughtfulness they bring from it, and the global perspective they bring is very important. As we at the Digital Dollar Foundation, in our partnership with Accenture and the Digital Dollar Project, think about what a future CBDC might mean for the United States dollar. And our focus is relatively narrow in that regard, because we are focused on the dollar and its role. And as we think about that, in our white paper, we put forward what we call our champion model, which has a number of elements. As John noted, is token-based, not accounts-based. It's distributed through the existing two-tiered banking system. And at heart, we believe that its form should follow function. And just as John and Cecilia said, you have to ask yourself, what do you want to achieve? And then I think a lot of the functionality and the design choices come from that. And there are many design choices. There's no perfect one. Everyone has a balancing aspect. But at heart, when we stopped and spent time thinking about the dollar, we really came down to a set of values that we think are embedded in the dollar in its current role as a global reserve currency. And we think making sure those values are embedded in a digital form of the dollar, a digital dollar, a US CBDC, is critically important. So what are those values that we seek to enhance and preserve and improve for a generation to come? Well, we think about things like proper balance of privacy against law enforcement needs of the state. We think about the rule of law. We think about free enterprise and free capital markets freed of state interference. And we think about the attributes that we believe are embedded in the dollar that have made it the premier world reserve currency. And as it's different states, both democracies and non-democracies, start rolling out elements of digital currency, we think other values may be embedded in them. State surveillance, as was noted in an earlier video, or interference in markets. And so we think ultimately, when you design a central bank digital currency, making sure you embed in it functionally the values that a society holds dear are critically important. And so as we've been spending a lot of time thinking about this, we think ultimately we come down to it's about value choices. And as we look at each little design element, how do those value choices play out in those design elements are something we spend a lot of time thinking about.
One of the most interesting things, Benoit, when you think about the history of the BIS, it's something that I tell my own students when I teach them, is just how much that institution has adapted over time and evolved with the very concept of money. From gold to fiat currencies. I mean, the Basel the Bank for International Settlements has evolved along with the monetary system. And as its own sort of prominence in international monetary relations has risen, it's had to navigate the fact that countries actually do have different values. And they do have different kinds of priorities, and they lie on different sort of points in economic development and the like. And here, when I'm listening to Christian Carlos speak and Cecilia, you're hearing about values and priorities, and thinking to yourself, well, what is the problem you're trying to solve? And when you're asking yourself about problems, what's your perspective about what a problem is? So you can ultimately certainly foresee a world of different kinds of CBDCs, in part reflecting different kinds of national values. And here the BIS is going to sit at the middle of it all, trying to think about questions that you're grappling with of interoperability and how exactly would a world of multiple CBDCs sort of operate from both the standpoints of financial stability and from a monetary perspective. I mean, how do you go about thinking about interoperability, even where you may not know the very specifics as to the designs of any sort of CBDC that may be in the making?
So it's clearly not an easy question you're asking, but let me first say that I fully concur with Chris and with you when you say that that CBDC will be a matter of national preferences. It will be a matter of national taste, and there will be different CBDCs, and that's because it's fundamentally a sovereign decision. Which is also why some of the concerns we can hear about the international spillovers of CBDC are, in my view, a little bit overblown, because CBDC projects are primarily for domestic purpose. Parliaments are not very excited by international matters usually. They really focused on what is good for their citizens, and rightly so. So these are fundamentally domestic projects. And so you might ask, why is the BIS role there? And if CBDC is a matter of national taste, why should central banks work together, right? Well, first, they can pool resources, and that can save a lot of time. And that's a little bit what we've started to do in this report, which we've been mentioning, trying to work together to advance faster. And that's exactly what the BIS Innovation Hub is meant to do, pooling resources, to have joint experiments, so that you don't have to duplicate resources, and you can move faster. And second, there are issues related to the way the system works as a system. And I think we all agree that the well-functioning international monetary system and international financial system is key for global prosperity. It's key for growth. And that's where interoperability kicks in. Now, interoperability is a little bit of a catch-all word. I mean, it can mean different things. It could mean that CBDC platforms in different countries are connected. It could mean that CBDC platforms are built on common standards, so that private operators, private players can access them. And that's very important, because as Cecilia rightly said, we need private players, we need payment service providers to be active using CBDC and connecting different places nationally and internationally. And that could also mean that end users could use multiple CBDCs in the same wallet, for instance. So these are different meanings for the same word, which is interoperability, and there are different technical answers. And that can also mean that countries' jurisdictions will be connected through their traditional payment system, RTGS systems. And if you have a good way to connect different RTGS systems in different places, and then CBDC is settled in the RTGS system, that's also a nice way to interconnect CBDCs. So you see there are different ways to do it, and that's why the discussion on CBDC is very, very closely linked to the broader discussion on cross-border payments, which John is leading for the G20 under the G20 action plan. It's one part of this broader discussion on cross-border payments.
Yeah, just that in and of itself, from being in the United States, where we have sort of parallel conversations going on in terms of our RTGS systems, not to mention sort of larger conversations on a CBDC, it makes that kind of balancing act really interesting. And I think we may return to that shortly. But when you talk about interoperability, Cecilia, and you think about, well, let's talk about a more ambitious form of interoperability. You may, I'm sure, be familiar with some of the concerns people have about CBDCs, particularly from countries that have very large GDPs on a global basis, and the relationship of a CBDC vis-a-vis other kinds of countries, particularly about the transmission of monetary policy internationally. And then there are some real concerns that CBDCs could create not only monetary problems, but also sort of either political or financial ones, to the extent to which money creation is effectively shifted entirely to central banks from the commercial banks. Is this something that's kind of come across your radar? Do you think that these concerns are overblown? And from a policy standpoint, how do you go about kicking the tires, if that's the right metaphor, of a CBDC project to help diminish both the risks that are perceived and the concerns?
Well, there were a number of questions in that question, but let me start with the saying yes. We have all these questions. I've spent several rounds around the globe before the pandemic hit us all, discussing this issue. So I'm familiar with them, and they're all very good questions. And if I start with the national arena, and this idea of a CBDC sort of taking over everything and would harm the banking system. Well, first of all, we have to remember history here, that central bank money in the form of cash and commercial bank money in the form of accounts have been working side by side for the best part of 150 years. So this is not a new thing. This is just technology changing, and we have to make decisions on how to adopt to that technology change. And over time, deposit money has become more and more available as making payments. And one of the ideas from the report that Benoit and John chaired that we talked about, and it was launched just recently, is the sort of the do no harm principle, that we need to meet our historical role, making payments safe and efficient, but also meet our other objectives, which is financial stability and monetary stability. That's why we are conducting monetary policy. Now, as technology changes and the sort of the national borders here becomes a bit more blurry in this area, I think it's important to remember that, first of all, money is a competitive industry. If you look at history, it's really something attractive to have the rights to issue money. It's like an endless loan where you pay no interest. So of course it's attractive, and that's why governments sort of traditionally regulated it. On the other hand, the payments, but you can't. Sometimes when people talk about CBDC, they only talk about CBDC, but you can't really talk about it without talking about the whole system. And money and making payments are, they're very intricate. And the payment system is, you might think it is also competitive, but if you think about it, it's actually not a very competitive market at all. It has strong network effect. So just for instance, most people doesn't carry around one card for each shop they go in. They use one or two, and that's why we have MasterCard and Visa and the likes that are global players. So when you think about CBDC, and you get the question, I get the question, what is the purpose? You can try flipping the question and say instead, what is the situation that we don't like and the CBDC could help us to avoid? Well, it would help us, depending on design again, it could help us to avoid a number of unpleasant situations. And one is that small countries, such as my own, sort of lose control over what I would like to call the monetary sovereignty of a country, meaning that if other countries are making more efficient, more up to sort of leveled up the game with and take over, you can get something which has been called a digital dollarization of countries, which a number of countries wouldn't like to have. And that brings me into my last comment about this, which is how do you design the system on a global scale? And that's hard, and I think some countries, and it doesn't necessarily have to be advanced economies. I find it much more plausible that there will be smaller countries which really have financial inclusion problems, that they will start this, because they don't really stand to lose as much as big advanced economies if things goes and you have to adjust the system a little bit on the way. And then other countries will learn from that and pick up, and there will be national deviations, but along the line we will sort of put the systems together, and more countries will probably latch onto it. And I think in about sort of 50, 100 years from now, people will go back to debates like this and said they were really worried about a number of things. They were worried about the wrong things, but I think I'm optimistic that we will get there in the end.
So there's a very famous clip in the United States when Bill Gates was first trying to describe the internet to a very famous comedian, David Letterman. So I guess you're sort of saying we'll have this, maybe they'll be looking at this clip and saying, wow, there are many people very concerned about CBDCs. Well, John, I mean, do you have, or do you share that kind of optimism, particularly, when you look at the transmission of monetary policy and the relationship to sort of how the introduction of a CBDC could impact lending with domestic banks. I've heard certainly from many financial institutions and many banks who, where people have expressed some concern that it can not only impact their business, but really sort of shift lending and the money creation role out of the commercial banks and sort of move the balance of power to central banks. Is this something that you've thought about as a realistic concern, or is it just sort of an overhyped concern? And especially when you think back and you get back to your original sort of driver, which is the disappearance of cash, right? So if you start to see a disappearance of cash and you see the introduction of a CBDC, and depending on the design features of that CBDC, if you see more of the sort of literally financial power migrating to the central bank, is this a kind of a disaster scenario, or is this something that warrants considerable thought?
So I think I'd say it's a real issue, but you shouldn't blow it out of proportion. I mean, what we've been talking about, as you say, is a retail payments-based CBDC, not a CBDC for monetary policy purposes, and also a CBDC that would exist with other forms of money, commercial money, maybe private sector digital money, properly regulated. And I know you had a discussion earlier on about stablecoin. The key thing is we don't know the behavioural response of people to a central bank retail currency, digital currency. We don't know whether they'll want to keep all of the money they currently keep in commercial bank deposits for transactional purposes in it, or whether they'll want to keep some in it and maintain their normal retail accounts. It's possible that you might need features within a CBDC, going back to that foundational principle of the report. A number of people have mentioned do no harm, and do no harm to monetary stability and financial stability. It might be that you would need some features to ensure that it wouldn't destabilize or cause problems for the monetary policy transmission mechanism. But at the moment, I think I don't see that as necessarily the main danger, or potentially a likely danger. And on this question of financial stability, a number of people have alluded to the problem you might have with bank runs. People could run very quickly to a digital central bank currency, or even just the disintermediation of the banking system more generally. Again, I think we live with those issues now. I mean, we live with those issues in terms of physical cash. We have mechanisms to prevent bank runs and to deal with them when they occur. It may be that a CBDC, will need some additional features to deal with that, and that might mean restrictions. But actually, in the UK, certainly, if you walk into your bank with a huge amount of cash and want to deposit it, you might find there are some restrictions. And if you want to make a very large payment, even as a central banker, you get asked some fairly probing questions. So we live with restrictions and some would say controls on the way we use money now. I don't think it's impossible to design a CBDC that wouldn't be able to deal with that. And I think that just say that the issue is, again, to start with what you want to achieve and then see how you deliver the do no harm, rather than start with the things it might do. And it may be we have to start small, and as we learn about the behavioral response of people to having this asset, to go further. If I can make just one last point, talked about the balance of power between central banks and commercial banks, which obviously we're all fascinated by. But it's not that long ago, and actually I could even remember it, when if I wanted to use a credit card, somebody rolled a roller over a piece of paper with 4 sheets of carbon to do that. And I couldn't use a credit card to buy my coffee. And sometimes I couldn't use a check below £30, which was a much higher value in those days than it is today. The balance of power, if you like, what we see now in the use of commercial backed money in everyday life is just a huge shift that's occurred over the last 25 years. And these things move backwards and forwards. The book of Genesis didn't have within it a division between central banks and commercial banks. It evolves with technology and it will continue to evolve. We have to ensure it evolves in a way that meets our public policy objectives.
Well, I can say that you have now thoroughly done something that I had not anticipated, which was introducing theology into the central bank digital currency debate. Chris, I think that Giancarlo, I think that one of the interesting conversations here, I mean, the United States, the way in which we sort of oversee our financial system, our monetary system is quite interesting, because we have obviously the Fed board, and then we have the regional banks. And then even added to that, we have a very active and a very large sort of banking system. Even as chairman of the CFTC, you had talked a good deal about what an ideal sort of interaction would be in order to tackle some of the design questions, even once the government sort of creates or articulates what kind of values it would have. We were talking to Mark Branson, who had laid out sort of how he thinks about that kind of coordination between, in the case of the Libra Association, but also other cryptocurrency founders and technologists, sort of the ideal relationship between the state and different sort of cryptocurrency actors. When it comes to the CBDC question, how do you see that playing out in an American context in a more fragmented monetary system?
We talked about values, and John actually talked about the book Genesis, and that comes back to what I began the conversation with, and that is that, how does society enshrine its social values into its money? And in fact, another conversation I had with John not too long ago, he said to me, it seems like every several generations, society asks the same question again: what is money? And I think we're at one of those points in time, because of this new technological revolution in terms of the internet of value and the digitization of things of value, that we're once again asking the question, what is money? And it's not just central banks that are asking the question. Society at large is asking the question. In fact, we can think back 10 years, it was really Bitcoin that really started us down this road. And then it was other things like the pandemic, like China, and like Libra coin that have gotten all of us. And so I think there's a broad conversation going on right now that's not confined to the official sector. I think it's very much an official sector, public sector conversation. And so one of the things we're trying to do in the States at the Digital Dollar Project is bring together the conversations that are taking place in the official sector and the work that's being done in the private sector so they can benefit from each other. And in fact, that approach is consistent with the American tradition of the way we explored the lunar surface. It's consistent with the way the internet was developed with the DoD and DERPA, but also with the private sector actively involved in the development of the internet. And I think that as the United States goes forward in looking at a central bank digital currency, it's going to engage more directly with the private sector. And we at the Digital Dollar Project just last week put forward our proposals for a series of pilot programs that we think can explore both the retail use of this, but also wholesale use of this in different use cases. And I commend your viewers to take a look at that. It's on our website, digitaldollarproject.org. And we ourselves at the Digital Dollar Project in the next few weeks will be announcing a project that we're going to work on to start experimentation in this area. And we've been engaged with the official sector throughout, with the Federal Reserve Bank and with Treasury and other government agencies, because we want to really see this very rich communication between the private sector and the public sector. And I'll just end on this note. You know, I mentioned that's a U.S. tradition, but if you look around the world, that's what's happening in most of the other projects as well. Certainly China is engaged very much with its commercial actors in the development of their DEP. And I think that that's very much the way that this will continue to develop in the United States.
Yeah, you know, we only have a couple of minutes, but Chris brought up the big issue out there with China and particularly with their involvement with their CBDC project. You know, very, very briefly, I would like to get each of your sort of your opinions about whether or not, number one, how do you view this project in terms of how advanced it seems, and then what do you think it's doing to the conversation on CBDCs domestically for other countries that are looking about their own values and also thinking through what kind of money and monetary system they would like to have? We'll go in reverse order this time. Since you brought it up, Christian and Carlo, we'll start with you.
Well, you know, I actually think that if you categorize, as you often see in the press, the development of CBDC as a race, then they'll often talk about China's advanced start and obviously Sweden as well, but they define it in terms of who goes first. I actually think that's the wrong way to look at this. I don't think if there's a winner, I don't think the winner is necessarily who's first and the loser is necessarily who's last. What matters is which central bank successfully incorporates its societal values in a successful development of CDBC. So it's not a question of going first, not a question of going last, but it's a question of success in making sure that a CBDC has those values associated with it. And that's our focus in the US. Now, on the other hand, one can't be too late to the game here. And that's why we very much advocate that, at least in the US context, that the United States really get in the game and get active in the game in a way that it is increasingly, but perhaps it wasn't as much 6 months ago. So we're very pleased to see the United States accelerate its work in this because of interoperability. The last thing the world needs is for the United States to not be engaged and then wake up 3 years from now and suddenly say, oh, we are going to engage. And oh, by the way, we want to go in a different technological direction. We're going to not be concerned with some of the interoperability aspects. So the United States needs to be engaged now. But ultimately, it's about incorporating those values into a successful deployment of CBDC.
Cecilia, China, 30 seconds.
I think it's just a very excellent example of how a digitalized economy makes us all have to ask how we serve societal needs in the best possible way. This is digitalization that changes people's behaviors, changing the landscape of the monetary system. China seemed to be on the forefront. We also have to do our homework in terms of cash disappearing rapidly. We're just going to have to carry on, and it's going to have to be quite a rebuilding of the infrastructure and a little bit of a change between public influence and private sector influence before we get it where we want it to be.
John?
Yeah, so first of all, I agree entirely with Chris that the wrong way to look at this is to feel this is some form of race. And the Chinese actually were the first, I think, with paper money, so maybe they'll be the first with a digital currency. The key is whether you can meet your societal needs and your economic needs and find a way to reflect that. And I think given the way the world is and national jurisdictions operate, this will be first and foremost a set of domestic issues. Where we have a real opportunity, though, is unlike other periods of change in money and development of national infrastructure for payments, we actually have the opportunity now to ensure that we don't build in unintended barriers to interoperability in all the forms that Benoit discussed. And where we choose to limit interoperability, that's an actual choice we make, rather than, as what's happened in the past, our systems have evolved, and it's just been very difficult to achieve some of the gains we could get through managed and responsible interoperability. So I really think we have an opportunity, but you start from how do you deal with the needs in your own society and your own economy, while trying to be aware of what you do to make sure you retain the optionality on interoperability.
Well, our time is up, but I'll let Benoit have the very last word.
Well, I would also agree that it's not a matter of competition with China. So if you have a hammer, everything looks like a nail. So if you want to pick a fight with China, you can pick a fight on CBDC, but it's not about CBDC. It's something different. And when we discuss international cooperation over CBDC at the BIS in Basel, PBOC is very much part of it. And we have a very good and intense discussions and relations with CBDC. And when you look at the DCEP project in China, it's primarily a domestic project. It's not a geopolitical project. And the way I would say it is that they have these big tech players which are becoming fintech players or big tech in finance with huge networks, and they want to be on top of it. The authorities want to remain on top of it, and authorities want to be sure that digital currency, whichever way it is being done, serves public objectives in China. And that it's the same conversation everywhere. The objectives might be different, obviously, but the kind of conversation will be the same everywhere. And so there are lots of lessons to learn from their experience.
Well, thank you so very, very much. I mean, that topic in and of itself, I know is a big one when against the backdrop of the internationalization of the yuan and the like, but thank you so very much. This kind of conversation is vital. It's necessary, and just having you here for our audience is what DC Fintech Week is about, and I appreciate all of your time to come. You have been wonderful, both on camera and off with me, and I just wanted to thank you again for making the time. And I guess we will now be switching to our next panel. But before we do, we're about to make this jump now from CBDCs to non-governmental currencies and what they mean for the market. But before we do, I want to introduce our poll for the day. So shout out to Chainalysis for the support. The question is, for the audience, what, if anything, is stopping you from investing in cryptocurrency? Not CBDC, in cryptocurrency. And you can go to slido.com to input your opinion with the code DC Fintech. And we will, again, DC FINTECH, and we'll provide the results for those who do. And with this audience, I'm pretty sure there will be more than a little curiosity. And And with that, we are going to continue our conversation with one of the big draws of the day, Brad Garlinghouse. Now, Brad is, as many of our viewers know, the CEO of Ripple, and he is an alum of DC Fintech Week, where he wowed the audience in 2019 and was very, very popular. So I'm delighted to have the opportunity to get his views on not only our earlier conversation on CBDCs, but also the evolving regulatory environment. Well, I'm really looking forward to this panel, and I would like to welcome Aaron Stanley of CoinDesk. And big thanks to CoinDesk and the CoinDesk team for being one of our knowledge partners today. And Sanaya, thank you very much as well to Teja from TD Ameritrade, who was back from earlier today and on our panel on what's happening in crypto in Asia. And they will be here to moderate today's stablecoins panel. So please take it away.
Aaron, your camera is muted.
Great, thanks, Chris. And welcome everybody to our panel on stablecoins. My name is Aaron Stanley, and I'm Managing Director here for events content at CoinDesk, which is the largest blockchain digital currency focused media and events company out there. I'm joined by Sunaina Tuteja, Head of Digital Assets at TD Ameritrade. And for the next 45 minutes, we'll be digging into the topic of stablecoins. As Brian Brooks was just mentioning in the previous session, the third quarter was probably the biggest ever for stablecoins, not only in terms of market cap, but also in terms of adoption and the regulatory roadmap. So we're going to be diving in and breaking that all down for you. Sunaina, do you want to introduce yourself quick and then introduce our panel for today?
Absolutely. Thank you, Aaron. And thank you, Chris and team, for always finding the art of the possible and bringing us all together. Even though we can't all be in our favorite city of DC, it's great to be connected to amazing panelists offering amazing perspectives from around the world. And for me personally, it's a nice pivot from all the binge watching I've been doing to a week of binge learning. So thank you. As Aaron mentioned, I'm the Head of Digital Assets at TD Ameritrade. Clearly stable coins are top of mind, as you even heard, Brian in his conversation with Chris just now. And, I know every moderator is going to say this, but Aaron and I frankly believe that we have an all-star panel assembled here who represent operators, investors, regulators, and will really offer us a diverse slate of perspectives on this topic of stablecoins. And one of the cool things I also like about this panel is they come at it in a very balanced view. And what I mean by that is often things in crypto are nicely packaged with a healthy dose of hype and hyperbole, and stable coins are no exception. And, they're often presented as a panacea. And what's great about this panelist is they have a deep reservoir of expertise in this area, but they present to us not just what the opportunities are, but also what are the challenges and how we ought to pursue this exciting area of crypto with eyes wide open. And with that, I actually want to welcome our panelists and give them an opportunity to briefly introduce themselves. And I'll start with our friend Nick Carter, sporting his fancy Bitcoin pin there. So Nick, passing the baton to you.
Thank you, Sunaina. Thanks for having me. Chris, thanks for the invitation. It's a pleasure to be here, third year in a row. It's my favorite conference. I'm Nick Carter. I'm a general partner at Castle Island Ventures, which is a early stage blockchain focused venture fund based here in Boston. So we invest in financial infrastructure, startups building on top of public blockchains. And obviously stablecoins are a key linchpin of that. They're kind of a core shared permissionless infrastructure that a huge number of startups are building on these days. And so that's why we're so focused on the opportunity. I'm also the founder of Coinmetrics, which is a blockchain analytics startup. And we cover a huge amount of data pertaining to stablecoins. One of the amazing things about them is that you can directly see in real time the usage traits and the free float and the growth in market capitalization, which has been pretty astonishing this year.
Thank you. Fanny, over to you.
Hi, I'm Fanny Wang. I'm a lawyer turned entrepreneur in the blockchain space. I've worked in a variety of different projects since 2016. Most recently, I was Associate General Counsel at MakerDAO, which is a decentralized stablecoin platform. And I'm currently working on a few of my own projects and also working with the Red Cross on their own community currency program, which is a kind of stablecoin that is designed for economic activity for people who are living on $2 a day to actually generate more real production in the flow of goods and services amongst these communities. So happy to also talk more about that.
Looking forward to it. Always inspiring. Nigel, over to you, please.
Thank you very much, Sunaina. Thank you very much to you and Aaron and to Chris for the invitation. I'm Nigel Jenkinson. I'm the Division Chief of Financial Regulation Supervision at the IMF. And you know, the role of the team that I work with is to provide advice and support on anything in the area of financial regulation and supervision. Clearly, fintech is hugely important these days, and stable coins are one important aspect of that. And recently, I'm a member of the FSB working group on regulatory issues of stable coins, which issued its report last week. So great to join the panel today. Thank you.
Thank you. We'll definitely be digging into the regulatory aspect quite a bit, so appreciate it. And last but not the least, our friend Alexander.
Hello, everybody. Chris, thank you very much for the invitation. Sunana, Aaron, thank you for agreeing to, to run this panel. My name is Alex Lipton. For a little while, I was a professor of mathematics, and then for about 20 years, I was in investment banking, including the position of the global head of quants for Bank of America worldwide, and also quantitative solution executive for the holding group Bank of America. And then in 2016, I decided to go a little bit back to my academic roots, as well as to start an entrepreneurial enterprise. And so I became a fellow at MIT, a professor and dean's fellow at the Hebrew University, and the co-founder and chief information officer of Sila, which is an innovative programmable money provider based in Seattle, Portland. Portland, Oregon. Portland, Oregon.
Awesome. Never a dull moment in Alex's world. Okay. So, as you've been hearing today, a lot of talk about stable coins, and we certainly see a massive adoption and also proliferation of stable coins. But, an outcome of that has also become where stable coins have kind of become a catch-all for a lot of things that might or might not be a stable coin. And within the stable coin ecosystem, there's also, a multitude of use cases. So maybe let's start with some fundamental taxonomy. And for that, I would love to have Nick and Nigel weigh in, and maybe Nick, starting with you, looking at it from the perspective of the crypto world. How would you define stable coins, or as you've coined the term, crypto dollars? And then Nigel would love to have your perspective from an IMF standpoint, how you define a stable coin and the difference between, a quote unquote stable coin and so-called global stable coin. So I think different perspectives, but important for us to hear it out. And Nick, I'll pass you the baton first.
Sure, thank you. And I definitely didn't coin crypto dollar. I'm just an enthusiast of the term and a supporter of the term. I think it's not set in stone, the fact that stablecoin will be the dominant term that's used here. I know whenever I see things from regulators or like the FATF, they don't really like the term very much. They claim that it's promotional, and so they call them so-called stablecoins. So maybe a new term will emerge over time. It's not clear. The way I would define it would be a token circulating on a public blockchain, which is designed to track the return of a sovereign currency effectively. And there's a number of ways that this is attempted. One way is to have convertibility for dollars held in effectively commercial bank liabilities for deposits held in a bank. And then the other way, which is also pretty common in the crypto industry, is to create a reserve of risky collateral, which is kind of managed. And so that's not a convertible approach. So those are kind of the two main. So you have kind of the synthetic stable coins and the convertible stable coins. There's also algorithmic ones out there, which are sort of more exotic. Now, again, I think crypto dollar is more suited to describe the phenomenon, because we're talking about, for the most part, they're dollars. If you look at them, about 97% of all of the sort of circulating stable coins try and track the return of the dollar. And then crypto, to me, connotes the fact that they circulate on these open networks, which seems really important to me, because that's kind of the core value proposition. If you ask people to use stable coins, why they use them, it's because of this lack of encumbrance. So I would question if it would still be, a true crypto dollar if it was circulating on a private blockchain, for instance.
Thank you. Well articulated always. Nigel, I'd love to hear the perspective from an IMF vantage point.
Okay, thank you. Well, thank you, Sunaina. And just following up from Chris, I mean, I think the word stable coin is one that is bandied about a lot, and indeed, the report that I was a member of the group on, used the term so-called stable coins, because I think there is unease about the term as Nick described. But my definition would be, or categorization would be, it's a specific category of crypto assets, which aims to maintain value against a particular currency or currencies, or potentially something else, such as a commodity or basket of commodities. That would be how I would term stable coin, but I think, as Nick described, there's many different types and varieties of this. So I think there is a question about the term. On your point about global stable coins, I think a global stable coin is one which essentially is viewed as having extensive reach, within and across borders. So it's one that has a potential global and significant cross-border reach. But that would be how I would define it, Sunaina. Thank you.
Great. Well, thanks both for that. Now that we're all on the same page, more or less, as far as how we're defining these instruments, we're going to dive a bit into how they're being used and the volume at which they're being used. And I think the third quarter of 2020, as we mentioned earlier, was really a seminal period of time for stablecoins. In just 3 months, the total market cap of these instruments nearly doubled from 12 billion to 20 billion. And that $20 billion figure marks like a more than 1,000% year-over-year increase. So it's definitely the hockey stick growth, as acting Comptroller Brooks was alluding to on the previous panel. And we've been seeing stable coins being issued across a broader array of different blockchains as well. So there's stable coins other beyond like Tether, which is kind of the the largest by market cap. But there's multiple other stable coins that are being issued across different blockchains, and there's really being there's a massive amount of uptake here. So there's a lot of factors that are driving this. So I think we'll turn to Nick initially, because that data I was just stating was from Coinmetrics, your company. So maybe let's get some color from you on just the uptick in adoption here, and then so who's issuing these? Like, what are people using them for? And then I'd like to turn over to Fenny as well to talk a bit about what you've seen in the maker ecosystem with DAI. So Nick, go ahead. Sure, yeah. So the biggest stable coin, again, people might question whether it would be considered stable or not, is Tether at about $16 billion of market capitalization, which is much larger than the second largest one, USDC. And one of the interesting features of the system is that the entities that use these stablecoins don't necessarily want third parties to know what they're doing with them. So it's always a challenge to get reliable data on what the usage modes are. They follow kind of a semi-private, not fully private, but sort of semi-private model where you don't necessarily need to, share KYC data with the blockchain to make a transaction. All you need is a wallet, effectively. But there are kind of a few key catalysts which I think can help explain the growth of stablecoins.
One is more crypto companies denominating their balance sheet, transforming their working capital into stable coins to have liquidity, which is present on crypto rails, which means they can kind of access opportunities much more quickly as opposed to having fiat currency in banks on their balance sheet. Another one would just be the rise of commerce denominated in stable coins. There's plenty of venture funds out there that are settling deals in USDC terms instead of sending bank wires, because these are 24/7 networks. You can settle and close a deal on a weekend. And then one interesting feature of the last few months is the rise of, this is a very idiosyncratic crypto concept, but the rise of kind of yield farming, it's called, which is effectively a new way of issuing pseudo equity tokens on public blockchains. And the way that people would get exposure to that would be by effectively locking up some collateral in a smart contract. And the preferred means of doing that was with stable coins. And so that basically created, structurally high interest rates in the crypto industry on public blockchains. And that sort of sucked in a lot of collateral from the regular banking system into the crypto system. So that probably explains a lot of the growth in the last year. But as I said, some of it is also mystery because stablecoin users aren't necessarily that forthcoming with their intentions.
Great, thanks for that. Fenny, what have you seen in the maker ecosystem with DAI?
Yeah, so I'll explain a little bit for those who aren't familiar about Maker and how DAI works. So DAI is a little bit different than a stable coin such as USDC. So going back to perhaps the taxonomy question, you have certain types of stable coins that are one-to-one backed by fiat in some bank account. There's an issuer that's regulated in some form. So we're seeing new regulation trying to clarify that. But in those cases of USDC, there is a dollar somewhere, and against that, you can issue this ERC token representing a claim on that dollar in a bank account somewhere against the issuer. But what's different about DAI stablecoin is that it is possible for someone to generate or issue DAI themselves against their crypto assets. So what's different here is you are putting up your crypto assets, say Ether, as collateral against which you can issue DAI. So you get the benefit of having a stablecoin like DAI, which you can use in various applications as a form of crypto payment or for the yield farming phenomenon that Nick described. But you get to also keep your underlying collateral. So if I wanted to get USDC, I would have to sell, say, ETH or some other, or use cash to get the USDC and do something with it. But with DAI, I could generate it by putting up my crypto assets as collateral. Now, of course, there is a collateralization ratio, so I have to over-collateralize against the amount of DAI that I'm generating. So if the prices of the underlying collateral decline, then there's a risk of getting liquidated. So that's how the overall MakerDAO system works as a general concept. There's been exponential growth in the supply of DAI the last couple of months because of what's been happening in the decentralized finance markets with the advent of yield farming, as Nick described. So I think I'm looking actually at the block Explorer right now. So this is all up-to-date information. There's close to $1 billion or $1 billion actually worth of DAI outstanding in circulation. So it's quite a phenomenal level of growth. And there's questions as to how these different types of stable coins will be used and compete as the market matures, which I think is quite exciting.
Great. So since we're kind of on the topic of decentralized finance right now, and we're talking about yield farming and some of these other applications, maybe it'd be a good time to dive into that a little bit more, just briefly. One of the big sort of developments of the last few months has been the emergence of these new exchanges that are essentially automated market makers, and a lot of stablecoin volume has been locked up on these exchanges, or have been provided as liquidity on these exchanges. Alex, can you explain to us just what exactly like an automated market maker is, and why people are putting their stable coins in these protocols?
Oh, yeah, with pleasure, Aaron, with pleasure. So you know, automated market maker is actually an idea which is very pertinent to the framework of Ethereum and other blockchains, which you know, provide consensus as a service, if you wish. That's what Ethereum really does. And then you can run all kind of tokens on Ethereum itself without bothering to you know, make sure that they are internally consistent, because that would be done for you by the Ethereum protocol, right? Of course, make no mistake, Ethereum protocol is not nearly as powerful as people think it is, and it's extremely expensive. So basically, it all comes with a price tag attached, and clearly, you know, some other consensus mechanisms are needed in order to make this whole idea practical. But however it might be, given that in the real economy, interest rates are de minimis, people are looking for something else to do. And so one possibility is to become a market maker, right? Right now in the real economy, you know, only huge really huge efforts need to be exerted to become a market maker. So the Citadels of the world, one of my places where I used to work and so on and so forth, are very, very big, but they spend billions and billions to build the infrastructure and so on and so forth, whilst smart contracts offer a very cheap alternative. You put in a pool of liquidity on both sides of a market-making effort. So, for example, between two stable coins, or between Ethereum and say USDC, something like that. And then you actually follow a very simple rule. So, for example, one of the popular rules is that the product of the number of tokens on one hand and the other hand is constant, as simple as that. And indeed, if you think about it, this rule will never exhaust the pool. It will adjust to the outside evolution of the price, etc., etc. And then what is bad?
What's my motivation for, like, what would be my motivation to put my DAI into
well, I will come to that, because by doing this, right, by doing this, you become a market maker. So being a market maker is simultaneously an obligation and a privilege. On the privilege side is that you will be collecting the bid-ask spread. Essentially, when I try to take, for example, one token in exchange for the other, I actually need to put a little more of the token which I need to put in, and that is kind of bid-ask spread. Essentially, think about it, that on top of the equilibrium price, you will be kind of collecting 1% bid-ask spread, which is a perfectly legitimate way to do this, and that's how it is done in real world as well. Maybe not 1% smaller than that, but still, right? And then, you know, if the price of these two tokens oscillates around the equilibrium, then you will be chocolate, because you will be collecting this premium, and it will be a machine for producing essentially yield, right? So you put in 2 pools of collateral, and you now get a constant reward, right, in the form of dividends or interest. You can think about it as, you know, as a bond of some sort. However, you know, as everything else, you know, the hype goes ahead of common sense. So essentially, the product itself has, in the parlance of conventional mathematical finance, has negative convexity. It means that deviation from the equilibrium in both down and up will always result in the owner of the pool actually losing money. This is kind of the way it is done. As I said, if people don't like the word stable coin, they should probably like even less the concept of impermanent loss. So impermanent loss is perceived that when you deviate from the equilibrium, you lose money, but then you will come back to the equilibrium. So if it does come back to the equilibrium, you receive your returns in the form of market making fees. However, if it deviates away from it, you will lose money, and arguably more than you put in. So that's in essence how the whole thing works. To make a long story short, the smart contracts allows you to compete in a very naive way, but still to compete with big boys and girls who are doing market making for a living. And if everything goes well, you will be receiving a stream of dividend for your effort. Yeah, that's
sure. So it's essentially the democratization of market making.
Precisely. You can think about it like
any average Joe can pool his. Like I for instance have some guy pooled in a Uniswap liquidity pool right now, and I'm earning a steady flow of the trading fees that come across that. And I guess I probably am a little bit naive about it, as you mentioned, but I'm one of those naive people. But,
well,
but I'm learning.
You know, markets.
That's the fun thing is that we're learning. Like we can actually experiment with these things and learn on our own.
Exactly.
It's not just for the Wall Street elite, you know.
That's exactly right. That's exactly right.
So Sunaina, since we're kind of talking about use cases here, did you want to tee up kind of next round about just where where else these coins are being used, aside from automated market making?
Yeah, and you made a good point there that these things are supposedly built for people not just on Wall Street, and maybe I would kind of offer the contrarian view that while the ethos of financial inclusion and leveling the playing field for the masses is a stated goal of many crypto projects, especially in stablecoin, we still have a pretty wide delta between that rhetoric and what we're seeing in terms of actionable use cases. So maybe Fenny, you can convince me otherwise, because in your opening you did talk a little bit about the merit of using stablecoin for community initiatives and how it can help local economies, and really kind of bearing the fruit of financial inclusion. So would love to hear more about that.
Oh, that's a great question. Thank you for that. So my first observation, having been in the DeFi space, is that all of these stable coins today, they're really primarily used crypto natives for crypto trading, speculative activities around whether it's DAI or USDC, and actually even with the one-to-one backed stable coins like USDC or Gemini Dollar or Paxos, I mean, in theory, there shouldn't be any fluctuation in the price of those stable coins because the issuers are regulated, and so you're supposed to be guaranteed this redemption at par. Actually, that's what the regulation in Europe around stable coins is clarifying, is this guarantee around redemptions and what those rights look like. So then I thought to myself, well, why is it that these stable coins all fluctuate in price? And it's because of the activity profile of who's actually using it. And where I get concerned is that if you have your predominant users of these stable coins are using it in these high volatility contexts for speculative purposes, is it wise to have ordinary consumers use the same asset? Because what you're effectively doing there is have the ordinary businesses and ordinary consumers who just want to use it for payment purposes, in effect subsidizing the stability or volatility of the activities of all the speculative trading using that stable coin. So that's one thing I don't think, it's a very subtle point that I don't think is appreciated yet. So that gets me to the point of, well, how do we think about using these stablecoin mechanisms in a way that is directly designed for stimulating actual economic productive activity? So this is where I get to the phenomenon of local currencies or complementary currencies. The idea around a community currency predates stablecoins way back. And Nick probably knows this history better than I do around free banking. So when banks were plentiful, they would issue their own sort of note. And then communities would also issue amongst themselves their own form of local currency, or basically like a voucher where they said, well, we don't have money, we don't have federal dollars, but we've got goods and services, we've got economic potential here. So instead of trying to barter, why don't we create this voucher that we will accept as if it were currency amongst each other so that we can stimulate economic activity? And as these projects kind of moved on, what they've discovered is that these local currencies are a great way to ensure that that capital and funding stays within a local economy. So the velocity of money is actually much higher for local currencies than the national currency because you're forced to spend it within that locality. And what's very interesting is taking this concept and turning them into cryptocurrencies for efficiency and greater data visibility. So a project that I'm working with the Red Cross in Kenya, they've been doing local currency programs predating crypto since 2010. And then starting in 2018, they turned that into a cryptocurrency that is being used by over 40,000 people now in predominantly rural parts of Kenya. And the phenomenon is getting to see this data from the blockchain, and you can calculate the velocity of the multiplier effect, right? How fast the money recirculates. So with an airdrop of say, 1.5 million USD worth of this local currency, you can see that it's been retransacted up to 11 times just within the last 9 months. So this is an incredible amount of economic activity that is being activated by having this cryptocurrency in the system. And so the idea here is, what if we could create so something like a USDC, but it would be within a jurisdiction. So in the US, we actually have a local currency program that's been in circulation since 2006 up in the Berkshires region. So Nick, I suggest you should go there and visit. It's in your woods. And they've created this currency called Berkshires that is used amongst all these local small businesses. And they estimate there's a 4 times circulation of that money, which is much higher than the US dollar, which only has about a 1x circuit. So basically there's no multiplier effects. So if we can get banks to issue these community currencies for their local economy, you get actually 2 multiplier effects. So I think Brian Brooks in the previous session talked about the Community Reinvestment Act. So this is my pitch to Brian. If you can get community development financial institutions, which are banks, some of them are banks, to be the issuer of community currencies, the reserves, the fiat reserves would go into these banks as deposits, and they can then lend out 90% of that into the community. And being community development banks, they're required to relend into these underserved communities. So you're getting a multiplier effect there from the reserves based on fractional reserve banking. And then you're getting this additional multiplier effect with the stablecoin itself, the community currency itself, recirculating at a higher rate within this network of local small businesses. So I think I think this is sort of the next phenomenon that I get really excited about, that here's a possibility of what this technology can do outside of just crypto trading.
Yeah, it's a really interesting use case. I think, just this idea of using it almost as like a local voucher program, or I'm even thinking of, when I buy like a coupon book to support the local football team or something, and I can redeem those coupons at different local stores and things of that nature. But I can't do anything with it outside of my community, but I can use it within the local area. So there's another interesting kind of commerce-based use case that I wanted to throw out there and see if folks had thoughts on this. But so CoinDesk reported last year that local Chinese importers in Russia were actually using Tether, the largest stablecoin, as a remittance service to send something like $30 million a day back to China. So these Chinese importers in Moscow, they would drop off bags of cash of Russian rubles at OTC desks in Moscow. They exchange rubles for Tether, send that Tether back to China, and then they would, exit into one and be a local market maker. And this was something like $30 million a day that we reported this was happening. And it kind of highlights this idea of censorship resistance as a use case here. And Nick, I know you mentioned earlier that a lot of the people that are using these coins are, they don't necessarily want other people to know what they're doing or who they are. And without, making any judgments about what these people's intentions are, I mean, it could be perfectly fine. But what's your overall thinking around this idea of censorship resistance as a use case? I mean, is this like a net positive, or is this something that people should be concerned about?
I mean, honestly, that's largely the purpose of crypto financial infrastructure, is to make financial decisions that some powerful third party doesn't want you to make. If you look at Tether, you look at when the transactions occur, most of them are happening on Asian trading hours. So it's not necessarily a Western phenomenon. And what's the reason for that? Well, China has capital controls, and a lot of people have an interest in evading those capital controls. That's kind of a plain fact, and not saying it with any aspersions, but fundamentally, crypto, public blockchains, the entire premise is giving people more discretion over their wealth. And now stablecoins complicate that slightly because you have a lot of them have these centralized issuers that can freeze accounts, freeze balances at their sole discretion. In fact, Tether has frozen, I believe, 100 accounts, and USDC has started to freeze accounts. They have different standards for what's worthy of freezing. Tether actually has more of a hair trigger finger in terms of what's worthy of freezing, whereas USDC has said they'll only freeze balances with a really concrete request from law enforcement. So there's kind of distinctions there, but fundamentally, one of the key premises of stablecoins is flattening out the kind of global financial infrastructure and routing around the kind of established correspondent banking system and creating a new alternative. And that's what we see them being used for.
All right. Well, I guess that's a nice segue into our regulation topic here, right? So Nigel, tell us a bit about, the third quarter, we saw a whole sort of groundswell of activity on the stablecoin regulation front in the US, EU, other jurisdictions, multilateral bodies. Maybe give us kind of an overview of what some of the key developments were over the last couple months from your vantage point.
Okay, thanks very much, Aaron. Yeah, a lot has sort of happened over the last few months. I think the real catalyst for this was the G20 at the global level was the G20 summit or the G20 meeting held last week, where the FSB produced a report on the regulatory issues on so-called global stable coins, and that sets out really 10 high-level recommendations for the regulatory community on how to approach the regulation of global stable coins. Those principles are necessarily at a relatively high level because of some of the issues that have already been discussed and challenged. There are many different types of stable coins. So actually, the regulatory issues are rather different and depend very much on the particular case. But the high-level principles and recommendations are designed to frame the overall approach by regulators. And what we're now seeing in some national jurisdictions, you mentioned the US and EU, is we're now beginning to see national frameworks adapting or issuing their own sort of regulatory rules on guidelines on different aspects of stable coins. But as well as the work by the regulatory group, we also have seen reports coming out by the Financial Action Task Force, and also the IMF itself has done some work, and indeed is published today, on basically the kind of cross-border payments and digitalization, which includes stable coins, but a lot of it is about cross-border digital use of digital currencies. And we've also seen agreements at the G20 level on a roadmap for improving cross-border payments. So I think all these things are kind of coming together in a sense of tackling some of the issues in respect of can we improve the payment infrastructure, particularly the cross-border payment infrastructure. And the regulatory group on stablecoins is really setting out a frame and set of parameters to try and ensure that one can maintain financial stability, that one can maintain trust and confidence, that one can address financial integrity, and that one can meet money laundering kind of rules and regulations. And some of those, of course, are quite challenging, given the comments that that Nick just mentioned. But I think if stable coins are going to have extensive use, these are issues that have to be addressed and have to be tackled. So I can pick up any more, but that's just a high-level introduction, Aaron.
Yeah, that's, and that's really helpful, because oftentimes when we're in the US, we also get very myopic and only think about our own jurisdiction. So it's good for you to help broaden our perspective so we can learn from other, global partners. Having said that, maybe kind of understanding kind of the European landscape, as you mentioned, Nigel, kind of looking a little bit closer to home. As Aaron mentioned, the last quarter was amazing for stablecoins in terms of their growth and proliferation, but it was also quite an eventful quarter in terms of the regulators really leaning in and starting to weigh in. And I think we can all acknowledge, and we have, that the future scale and sustainability of stablecoins is intertwined to the actions of the regulators. So in the US, when you take a look at what the OCC and the SEC have opined on, what does that tell you in terms of the future trajectory and sustainability? And Nick, maybe if I can start with you to weigh in, and then Nigel, would love to kind of get your follow-up perspective as, in looking at it from a European vantage point.
Well, I think the big open question is what will happen to Tether. Honestly, that's the elephant in the room. That's $16 billion held in offshore banks, unclear which banks they are. And we know the NYAG has been trying to sort of reckon with them for a while and trying to apply pressure to them, but it's not clear what's going to happen there. If that does happen, if something adverse happens to Tether, that's a systemic event for the entire crypto industry, because so much of the exchange environment is denominated and settled in Tethers. The other big outstanding question for me is, what are the legal assurances of a transaction that you would make with a US domiciled fiat convertible stablecoin like USDC? If you look at their terms of service, it's actually, they admit that there's still open legal questions as to what the quality of settlement is and the enforceability of those transactions. And then there's this notion of whether the privacy model of stablecoins can persist. Issuers don't really have knowledge of every transaction that happens on a P2P network. They have knowledge of their counterparties who are creating and redeeming stablecoins. They don't have knowledge of every peer-to-peer transaction, even if it is with their coin. Can that much more open model persist? That's kind of the really big outstanding question for me.
And I think privacy is definitely one that's gaining a lot of dominance, including comments today from Chairman Jerome Powell. Now, he was talking about CBDCs and US not so much doing it first, but doing it right. And privacy was something he spoke about at length. Nigel, maybe a more pointed question, because we're up to time and I want to give Aaron time to close, is do you see future regulation driven by collaboration with industry or more so driven by enforcement?
I think regulation, what will happen in terms of regulation is there will be continued work by the regulators to try and provide reassurance that they are on the top of what the particular risks are. So the risks here that we've discussed are is the relationship governable? Is there appropriate data information? Is there appropriate clarity? Some of the issues that we've been talking around today are hitting some challenges if you look against the high level principles which have been set out by the FSB. I think the high level principles by the FSB will be the guiding force, and I think there will be quite a bit of regulatory activity by national regulators trying to translate those regulatory principles into actual frameworks. And I think that is what's going to happen at the high level regulation. Then at the level of individual actions, that will be for the national regulators with individual cases. And I'm not going to talk about that.
Fair enough. Fair enough. Over to you.
Can just really quick, I'm going to turn over to Alex here, and then we'll wrap it up here. But Alex, so a couple of months ago, you wrote an op-ed in CoinDesk arguing that the only way for stablecoins to really achieve mass adoption is to effectively sever their connection to the banks or decouple from banks essentially as collateral holders, and then find a compliant way of keeping collateral outside of the banking system. Maybe in like 60 seconds or so, can you kind of summarize your argument there as far as like why you think that's necessary and why it's challenging?
This environment changes fast, but I keep my views, at least, for a period of 2 or 3 months. So my opinion right now is the same as it was in this paper. I really think that we underappreciate the instability of the banking system itself. The idea that you have an analog or equivalent of fiat currency backed by banking reserves, to my mind, doesn't make much sense, because even the best of the banks are still having, maybe 1% probability of default per year, which is not small at all, right? So from that perspective, I think that either creation of specially oriented narrow banks, something which I entertained for a little while, leaving Bank of America, but was never given a get-go by the Fed and stuff like that. But simpler versions, including potentially broker dealers and other organizations which can actually hold collateral backed by short-dated government paper and held to maturity, and other vehicles of that nature seem to be a much better solution to the problem. Not to mention the other thing which is constantly forgotten in all these discussions, and the only reason why it is forgotten is because the sliver of stable coins, however fast it grows, is still minuscule in the big picture of things. So the other thing is that if one were to keep the collateral with the banking system, then there would be 2 sources of payment tokens in the system simultaneously, which will increase the inflation rate, overall, which is an Achilles heel of schemas like Libra, for example, and in fact unsurmountable in their way of thinking about it. So in summary, in the remaining 6 seconds, I can say, yes, we need to do our utmost to find ways of keeping collateral outside of the existing banking system in a legally, regulatory compliant fashion.
They will be securities. Sorry, I just wanted to say that in that model they would be securities.
Well, it's rather nuanced, and maybe we can discuss it offline, given that we have negative 2 minutes to continue.
All right, guys. Well, thanks, Fenny, Nick, Nigel, Alex, Sunaina, and special thanks to Chris for hosting us today. And we'll turn it back to you guys, Chris.
Thank you very much.
Hello, my name is Lee Reiners, and I'm the Executive Director of the Global Financial Markets Center at Duke Law. At Duke, I teach a class titled FinTech Law and Policy, and I begin the course module on cryptocurrency by asking my students to define money. Those who have taken an undergraduate economics course typically offer the standard economist definition that money is a unit of account, store of value, and medium of exchange. This is a definition according to the functions money performs, but it fails to explain what money is. In my paper, Cryptocurrency and the State, an Unholy Alliance, I explain the essence of money and contextualize the rise of cryptocurrency within the historical relationship between money and the state. The anthropological record is clear. Money is fundamentally a social technology that allows for the measurement of debt. This is known as the credit theory of money, and I provide a concrete example in my paper. But if currency is simply anything that is used to clear credit accounts, how do you trust that a specific currency will be accepted? Enter the state, who has always had a vested interest in standardizing units of measurement within their borders. Because all citizens must pay taxes and thus share a common creditor, government-issued tokens can freely circulate as currency within the community. People are willing to accept these tokens as payment because they know they can use them to pay their obligations to the state. Thus, the state's role in money's creation is essential. Now, history does offer examples of privately issued token-based money, but such money only works in close-knit societies where transacting parties know each other's creditworthiness. Cryptocurrency attempts to solve the geographic limitations of previous forms of token-based money by representing a new form of community that is made possible by the internet. However, cryptocurrency does not fit neatly within the credit theory of money because there's no underlying debtor. When you spend a Bitcoin, whose obligation does this represent? Bitcoins are not issued. They are created using computer code, and they exist as computer code. If there is no issuer, then who or what are Bitcoin users trusting? Satoshi understood the central role of trust in sustaining private currencies, which is why the words trust or trusted appear 13 times in the Bitcoin white paper. Rather than trust a third party, Bitcoin's revelation was its underlying blockchain technology that allows network participants to trust the information recorded on a shared ledger without trusting anyone to validate it. Despite this new form of trust, Bitcoin and other cryptocurrencies have yet to meaningfully challenge fiat currency in fulfilling the three functions of money. This is partially due to design reasons, and partially due to the continued hold of the nation state as principal architect of social trust. As the origin of money demonstrates, the surest way to accelerate greater use of any currency is to grant it legal tender status. But why would a state relinquish the benefits of its monopoly over legal tender? For this reason, no country recognizes Bitcoin or any other cryptocurrency as legal tender, although several countries have passed laws that facilitate greater use of cryptocurrency. In my paper, I describe how US agency interpretations are largely premised on the historical reality that currency is the domain of the sovereign, and that this definition could possibly undermine cryptocurrency regulations should any sovereign adopt cryptocurrency as legal tender. This wasn't much of a concern until Facebook announced plans for Libra in the summer of 2019. Due to Facebook's scale, Libra was the first real threat to sovereign currencies. When the head of Libra testified on Capitol Hill shortly after the project's launch, he noted that the primary benefit for Facebook was the ability to drive more commerce on the platform. And if there's more commerce, there's more advertising revenue. Just as the state utilized its status as common creditor to create and circulate sovereign money, Facebook would tap its unique role as a global online community and marketplace to introduce a native, borderless currency. Facebook may not be a common creditor, but it is a common platform. Libra exposed the fragmented nature of cryptocurrency regulation in the US. As policymakers sift through and debate proposals to clarify and streamline cryptocurrency regulation, it's important they keep in mind the relationship between sovereignty and money. Unfortunately, recent guidance from the Office of the Comptroller of the Currency that allows national banks to custody crypto assets and hold stablecoin reserves threatens to undermine the dollar's status by accommodating the use of cryptocurrency in the banking sector. The acting comptroller's support for stablecoins is premised on an understandable desire to speed up the settlement process for dollar-based transactions. The problem with this logic is that it evaluates currency through a technological prism, as opposed to looking at the qualities of the state standing behind the currency. If superior technology is the goal, it only makes sense to allow technology companies to issue and circulate currency. But as with Libra, even if a stablecoin is backed exclusively by dollars, the linkage becomes irrelevant the more the stablecoin is used. This process is what allowed the US to gradually decouple the dollar from gold and may allow a future Google coin or Amazon coin to ditch the dollar. This would, of course, make these companies even bigger and more powerful, which is something that should concern us all. I encourage you to find out more in my paper. Thank you.
Well, against the conversation on cryptocurrencies and the state, I'm very happy and delighted to welcome Heath Tarbert back to FinTech Week. Now, Heath Tarbert is the chairman of the CFTC, and like many of our speakers, works quite literally at the intersection of issues relating to the soundness and safety of new digital infrastructures. And when you look at the CFTC's particular spate or regulatory perimeter, it is indeed covering a number of cryptocurrencies and digital assets, and or indirectly, and in some instances more directly. And as a result, his views and his decisions are really critical to understanding what happens in the United States and in our markets. So with that, Mr. Chairman, Heath, thank you so very, very much for joining us again at FinTech Week. We've always really appreciated the CFTC and obviously your support.
Great to be here, Chris. Thanks so much for having me.
Okay, there was a really interesting conversation in the previous panel on stable coins, and obviously that conversation was even brought up in some way in our flash presentation from Lee. Do you have any thoughts on stable coins? Just given the fact that you have a lot of experience, not just over at the CFTC, but even from your days over in the Treasury Department. I mean, what has struck you when you're even thinking about stable coins from a regulatory standpoint about stable coins and the like as alternatives to money?
Yeah, great question. And as the last panel and the videos show, it raises many more questions than that. And so obviously, personally, my view is I find it fascinating. I'm always interested in financial innovations, but obviously they have to be responsible innovations. And so that's really the question when we look at things like stablecoin is how would they work? What kind of benefits would they bring? But also, what are the potential downsides? And can those downsides be properly mitigated? So obviously, there's always a question when you come from the Treasury Department as to KYC and AML requirements. So obviously, we have gone to great lengths in the wake of September 11th, which now is close to 20 years ago. But we really have a very tightened regime to combat terrorist financing and money laundering. And there's a real question, obviously, that if stable coins come to the fore, just with digital currencies more generally, that we could lose some of that. So that's always a threshold issue. But stable coins in particular raise a lot more issues. There's the issue, of course, of what do you do? What are the assets, the reserves that are held against the stable coin, and how would that work? What about redemption rights? And so it starts to look more, some could argue analogous to a money market fund of some sort. And then you have the link between a stable coin and a particular currency, and some of these were raised in the last presentation, and particularly the video about, well, what's the relationship there between the sovereign? Will there be a situation where the sovereign will effectively lose control over monetary policy? So those would be kind of the regulatory issues. I think there's also a host of practical issues as well. So for example, how useful is a stable coin if you're a retail investor? If it's linked to a particular currency, wouldn't it be better just simply to have a central bank digital currency, which is another topic of discussion, or a faster payment system, and there's a metaphysical question there. What's the difference between a central bank digital currency and just a faster payment system where there's an electric representation of a dollar, for example? And then ultimately, if you have a stable coin, but it's tied to a central bank currency, which itself could be devalued, if you're looking for a store of value, is that really where you want to go anyway? Or do you want something more like a Bitcoin, which represents arguably a store of value that is much more limited? It can't be replicated, and it can't be subject to inflationary policies of a central bank. So those are all the sorts of regulatory or at least some of them, regulatory and practical questions, I think.
Well, the viewers from of DC Fintech Week today now have heard both metaphysics being referred to. We also had from John Cunliffe the Book of Genesis being evoked to understand central bank digital currencies. So we are truly an interdisciplinary conference for sure. One of the parts or one of the more challenging aspects, obviously, that we have sort of thought through and that you've been thinking through is, whenever you have that novel digital asset, that novel crypto asset, is how do you go about the case of classifying them? And Brad Garlinghouse was on a little bit earlier. He was making a statement about just the general complexity of the regulatory environment and sort of making guesses, if one will, about different crypto assets and how do you identify its whether or not it's a money market-esque instrument or a security. But stable coins, it's really that's highly an interesting space because the way that they operate, it can be diverse, but they would also presumably have to go through the scrutiny as well as to whether or not they're a security and sort of fall under the ambit of the SEC, or whether or not and how and to what degree the CFTC would become an important player. How do you, when you think about that particular regulatory question, is there an assumption that many of these stable coins could, particularly if there were different contracts written that reference them, but do you think that we're entering more and more into CFTC land as stable coins become so important, and as their popularity grows really exponentially in many of these markets?
Well, just like a law professor would say, it depends, of course, on
that was quite good.
How it is structured, of course. And the interesting thing is, I guess this area is very confusing, and unless you're an expert like yourself, for many people watching out there, they're saying, well, how, can you break this down? And so the way that I basically say it is, putting aside the question of whether indeed it is legal tender, which I think would put it in a different category, the real question every time we see a particular digital asset is it a security, number one? And if so, the SEC has exclusive jurisdiction. If no, then is it a commodity, number two? In which case the CFTC doesn't have regulatory jurisdiction, but we have fraud and manipulation authority. And then third, is it a derivative on a commodity, in which case we both have fraud and manipulation authority, but we regulate it as well? The definition of commodity is really broad. So many things are in fact commodities. So unless it's actually legal tender and something very different, every digital asset is likely to be a commodity. But if it's also a security, it gets kicked out of our jurisdiction into the SEC's jurisdiction. So Bitcoin and Ether, for example, are commodities. We don't directly regulate them. We regulate derivatives on them, but we also regulate, we also can bring enforcement actions if there's fraud and manipulation. Now, stable coins are interesting because you got something underlying the coin. So it is theoretically possible that the relationship between the actual asset and the underlying is a derivative. And so you could actually have that third category where we regulate them directly. But it's all going to depend on how individual stable coins are structured.
Do you think that the CFTC, and this is obviously a question that could go to any regulator depending on the particular crypto asset that's in their backyard, but assuming that you do have a continued growth of stable coins, or derivative instruments that reference them, just as you do in many sort of fiat currency markets. I mean, does the SEC or does the CFTC have the tools in place, in your view, to really grapple with this new financial instrument that is going to obviously impact a number of markets, some more nascent than others?
Well, we're building those tools right now, Chris. So I'd say that we have committed to making innovation at the forefront of the CFTC and done a number of things in those areas, including elevating Lab CFTC to report directly to the chairman. And now Lab CFTC has a role alongside the other divisions, which is really important. We've also gone to great lengths to clarify our view on certain digital assets with certain advice that we gave just months ago. And we also have the two biggest classes of digital assets currently out there, Bitcoin and Ether, under our jurisdiction. And we have derivatives products trading on them. And so we are building out or seeking to build out a regime where digital assets can be treated holistically under the Commodity Exchange Act.
You'd also mentioned CBDCs, and we had a wonderful, as I'd mentioned, a wonderful panel earlier in the day. But I'm really interested for your perspective. I mean, does the CBDC project excite or scare you? I mean, your observations at the outset were very insightful. But how do you view that as potentially impacting your work over at the CFTC? I mean, do you envision that conversation to have relevance for the CFTC, or is this something that you see as really the province of maybe our banking regulators?
Well, I think the creation of it, certainly. So the initial question is, am I excited or scared? And I would say overall, I'm excited. The only thing that scares me is if the United States falls behind. So I definitely think, given that something like 20% of the world's central banks, particularly the advanced economies, even more so, are working on central bank digital currencies, I think it's encouraging that the Fed is working on it as well. And the United States needs to continue to lead in this area as we lead on most areas of innovation. It is really the province of the Federal Reserve, I think, in terms of creating this currency, certainly for the US dollar. And I'm pleased with what I hear, their collaboration with MIT, for example, in making this happen. I think it's really important that they work with the private sector. The government can do a lot of things, but I think if we were able to harness American innovation to help continue to propel the project forward, my guess is it'll get finished quicker, just like we did when we went to the moon back in 1969. So for us, it would enter our space. We wouldn't be directly, but you could see other central bank digital assets, for example, central bank digital currencies emerging. And because we do have some regulation of certain types of futures and things in the foreign exchange world, our jurisdiction would certainly be implicated at some point.
Interesting. Again, just continuing the international line of our conversation a little bit further. I mean, what do you, and I should say even broadening things out, not just for the crypto space, but also internationally. You've been busy, but what have you seen and what are you thinking about a lot of the regulatory initiatives overseas, and how do you think international collaboration and coordination should be looking like, especially when you think about the more cutting edge issues?
Yeah, no, it's a great question, Chris, and it's far more important now in the digital age than ever before. I mean, financial products themselves and financial markets rarely look at borders and jurisdictions among regulators. But that's all the more true when we're talking about things like digital assets. And so coming up with standards, with shared standards in IOSCO, for example, that's a critical project. The Financial Stability Board is working on it. And so I think in order to have a regime, particularly if we start to see the emergence of a global stablecoin, it has to be internationally coordinated. So we've been working on this now for several years with our international counterparts on sort of what should be the regulatory framework. And then more generally, it's really important that regulators talk to each other and share with each other. We have innovation partnerships with a number of regulators around the world, and we're looking to expand that. I would love, for example, to do something with South Africa, which is sort of the leading financial center for the largest continent in the world. And so stay tuned, for potential announcements on that and other fronts.
Great. I will stay tuned. Interesting. I guess, when you look at then, your to-do list and some of the biggest outstanding questions, particularly in crypto sort of oversight, I mean, is there one particular area or issue that either keeps you up at night or you think that deserves more attention, particularly in the next sort of 12 months, whether or not it be smart contracts or some other aspect of infrastructure for crypto assets?
Yeah, I would say there are two buckets of sort of two categories of things that I think we need to focus on as regulators in the next couple of years. The first is one that you mentioned at the outset and other speakers have mentioned, which is the need for certainty, for regulatory certainty and clarity. Clarity is one of the agency's 4 values. We think it's absolutely critical that we provide the market as much clarity as we can on what's a security, what's a commodity. And so we really want to work on that over the next couple of years, obviously hand in hand with other regulators like the SEC. The other big category that concerns me is we want to encourage innovation, responsible innovation. We want these markets to grow and thrive, but that means they need to be free from fraud and manipulation. And obviously in the crypto space, we're seeing some bad actors come in. And my concern is that They will come in and they will undermine not only the products, but the public's confidence in the products, and it could lead to a backlash. And so we are going after particular actors, for example, who try to manipulate. And many of our derivatives contracts, for example, the CME's benchmark indices is based on information from various crypto exchanges. So we need to make sure that they're reported with great integrity. And so we're watching out for those things. We're also watching out for offshore exchanges that are effectively offering derivatives products to US investors that aren't registered with us as a registered designated contract market. So you see, we've brought a case, for example, along those lines very recently. So those would be the things that we're really focused on.
Bringing things a little bit closer to home. I've been pretty active thinking about diversity in our regulatory agencies and the importance of it and what it means for our nation's agencies and the work that they do. And I know you've been thinking about it for some time. And maybe you could share your perspective. I mean, I know it's a conversation that's been picking up momentum here in Washington, D.C. and really around the world. And I'd just be interested to know what you're thinking about it and how the CFTC itself is thinking about making sure that our regulatory policies reflect, I guess, the larger ambit of Americans in our financial system.
Yeah, no, a fantastic question, and I want to thank you for your research in this area. So, taking the issue of the effective policies, we came up with a set of 5 strategic goals, and one of those goals is in everything we do, ensuring that the derivatives markets work for all Americans. And so we ask that question every time we do a major rulemaking. As far as diversity, more specifically in the agency, when I came to the agency 15 months ago, I tried to make very clear that diversity makes us stronger as an agency. So we have the most diverse executive team that I think we've had in CFTC history, but most importantly, across the agency, we have more women now serving in more leadership positions than ever before. But that said, 45 years is a long time, and federal agencies, changing them overnight is somewhat difficult. And one of the things in particular, your research is focused on African Americans. One of the reasons I think we don't see them in a number of leadership positions within the agency, let's say career policy post, is because many of the people holding those positions now have 10 to 20 years of experience. So there's really a pipeline issue. So that's something that we've focused on at the CFTC, is giving opportunities to, in particular, people of color, African Americans, so they can really take a leading role. So for example, in our position limits rulemaking, you saw presenters who were people of color, other types of major rulemakings. And these are the people that aren't necessarily leaders of the CFTC career staff today, but they will be tomorrow. And that's really important. The other thing I'll mention is that when you look at some of our key offices, so Lab CFTC, which has been so critical in working with you in putting this, doing some of the things this week, as well as the Office of International Affairs, each of them is over 70% women and minority. So really, these are the training grounds for the people that are talking to Silicon Valley, working on cutting issues, negotiating with foreign countries, and they're more diverse than the agency as a whole. But your overarching point, I think, in your paper is really important, and that's that at the very top of the leadership chain, at the chairman, the commissioners of these institutions, we don't have particularly African-American representation, and I think I'm hopeful that will change in future years. And Chris, I can't help but say, when I think who would make an outstanding future SEC or CFTC chairman, that there's very few people other on that list than you. You have a tremendous background, you know about these issues, and you're forward thinking. So I know you would be missed at Georgetown, but I do hope that in the future, you would be a candidate for these top roles.
Thank you so much, Chairman. I really do appreciate that. And I appreciate also just the time that you've been putting into this conversation and for joining us all. That's very kind of you, very, very kind of you. Okay, so we're about to now take a quick break, but we will be back in a few thank you again. The CFTC has been with FinTech Week as well since the very beginning. And it's always a delight to have the CFTC and the chairman with us. And we will be having another event later on with Lab CFTC, a little bit of instruction for companies who demo their tech with regulators. And we'll be talking about that a little bit later. But thank you so much.
Thank you.